from the payrolls number that we are going to be getting for November. Lots of emphasis and focus on this report. It's the final report that we're going to get here of this year. But Maddie, as you look ahead, many economists, many investment strategists are taking a look at this number, trying to glean exactly what this will mean here for the Fed going forward. Unlikely, I think, to say the least, to really change that macro view. But certainly if we do see a massive surprise to the upside or to the downside here, that could be something that obviously could shock the markets and really move some of the trades today.
And the surprise to the upside could indicate a little bit of a question mark for the Fed in terms of the degree of excitement around cutting on that December 18th meeting. Having said that, of course, it's not just about the labor market. Inflation also a key picture here, and we're going to be getting that data in next week. Also interesting in terms of the prior month here. Remember that jobs number coming in at 12,000, and it's going to be interesting to see how much of an upside surprise we could get here. Citibank saying, actually Bernstein saying this morning that we could get a surprise to the upside of 100,000 jobs added based on the ending of those strikes and also that hurricane-related impact to the labor market as well.
Yeah, the hurricane-related impact that obviously has created so much noise in the last few prints that we have gotten here. So maybe this print could give us maybe a slightly clearer picture of what is going on, some of the dynamics underneath the surface. Also keep in mind that it's holiday hiring season, and we know that just in terms of when the survey was taken and when the holidays fall, this was taken before many of the retailers did hire. So again, something to keep in mind as we look ahead here to that next print that we're going to be getting in just about a month from now. But when you take a look at the expectations, what we are looking to see here, non-farm payrolls expected to come in at 220,000. We also are expecting average hourly earnings on a month-over-month basis to decline slightly here to 0.3%, Maddie.
All right, well, let's get you those numbers here. The November payrolls report crossing the wire, coming in at 227,000, just above the survey number, which was 220,000. I want to take a look at that unemployment rate ticking up just a bit to 4.2%. The prior month was 4.1%, and the survey data also indicating 4.1%. Average hourly earnings rising 0.4% month over month, just above the estimate there. That was 0.3%. Again, that non-farm payrolls headline number coming in at 227,000, above that estimate of 220,000 here. Also taking a look at average hourly earnings year over year, again ticking up just a bit to 4%. The survey data coming in at 3.9%, but in line with the prior month at 4% here. Also awaiting those revisions as well to the prior month to see if there's a revision to the upside following the impact of that hurricane-related payrolls print. The September increase, again, pretty much bang in target for payrolls here. We will continue to cover all of these numbers as they come in and the market's reaction as well.
Yeah, you're taking a look at the quick reaction here. At least on our screen, we still have S&P futures. Now they are positive. There you go. So again, we're seeing a bit of an uptrend here on the heels of this print. When you take a look and drill down into the sector, some of the trends that we are seeing here beyond those headline numbers, you have employment trending up in healthcare, in leisure and hospitality, in government and social assistance. We mentioned retail there, obviously a focal point here during the holiday season. Retail trade actually lost jobs here for the most recent month. But again, that unemployment number that you mentioned there, Maddie, clearly will be a focus here this morning, taking up slightly just to 4.2%. Joining us now to break down these jobs numbers even further, we want to bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. We have Robert Sockin, the senior global economist at Citi. And Steve, let me go to you first just in terms of the market's reaction, the interpretation that we're seeing play out on Wall Street. What do you think of this print?
I think it's in line enough that the market's just going to do what it's been doing, which is continue the momentum trade. There's nothing in here to disrupt it. I think, my first reaction when I saw 227 was, wow, I was actually a bit surprised that it was this high. I'm seeing a 2-month revision to the positive side of 56,000, which is actually also a surprise. The unemployment rate, ticking up 0.1% to 4.2. It looked like the labor force participation rate fell to 62, fell a little bit. But to me, the other one that I think people aren't really focusing on too much is the monthly wage increase, 0.4%. Last I looked, if you annualize 0.4% and the prior 0.3%, that annualizes to quite a bit more than 2%. We're talking 3-4%. That doesn't help the Fed's narrative. If you're on the side of hoping for rate cuts, before the number we were about a 72% chance, looking at a 72% chance of a rate cut. We'll see what the market has to say about that, because certainly Powell didn't seem to imply that either yesterday.
Well, let's talk to you about that, Robert. What are you thinking in terms of the Fed impact of this print?
Yeah, absolutely. These are all great points, and I think for the Fed, these numbers are going to be right in the spot of what they were looking for and they're comfortable with to continue easing policy, at least at the December meeting. So I would expect very much that for the Fed, this doesn't change the narrative that likely rates are restrictive and they have to at least come down a bit more at a gradual pace. You know, they'll be looking at some things that are concerning in the report, maybe a little bit of the uptick in the unemployment rate, a little drop in participation, but these numbers are extremely volatile month over month. And so the best thing is to kind of smooth through the last several months, especially with the volatility we've had in the reports. And the reality is we're getting an unemployment rate that's kind of staying in the low 4% range. That's sort of the definition of a soft landing. And so I think when you look over the last several reports, they'll be fairly comfortable that they're still getting that soft landing, but there are enough risks that I think they still need to lower rates.
So Robert, we shouldn't be reading too much into that slight uptick then that we are seeing in unemployment rate.
I think that, historically, what we've seen in the past is when the unemployment rate started to rise, it tends to keep going. And then when the SOM rule was set off in the summer that the unemployment rate rose more than 50 basis points relative to its prior 12-month low, people got very worried. But we've mostly been moving sideways since that period, which is very different than what we've seen in history. And so I think if we're able to stay around these levels, this would be kind of sustainable unemployment for the Fed. Now, of course, the worry is you could go higher from here. I'm watching layoffs in particular very closely for that. And when we look at the jobless claims data, layoffs are very low. And so I think right now, not a concerning figure.
What is concerning then in terms of that average hourly earnings going up, Steve? I wonder if there is an inflationary backdrop under the hood of this print.
That's exactly what concerns me, Maddie. When we think about it, the Fed's dual mandate is stable prices and full employment at a non-inflationary level. So if wages are rising. Now, let me stipulate, the idea of more people getting more money in their pockets is not a bad thing.
And maybe not a bad thing for equities, too.
Not a bad, people have money to spend, and we've had the mixed range of retail earnings where it seems like, stuff like people spending money at Lululemon, but not necessarily in the dollar, in some of the dollar stores or some of the other things. So it's a bit mixed. So people having money is a good thing, but again, if the wages are going up faster than the Fed's target, that doesn't help them meet their stable prices mandate. And to Robert's point, the idea of full employment, 4.2% unemployment is a number that most administrations would have died for in some of the old days. That's a really low number by long-term historical standards. So this to me says maybe Powell was sort of leading us in the correct direction of you may or may not get 25 basis points in December. He didn't explicitly say no, but maybe curb your enthusiasm about 2025.
Yeah, Robert, do you agree with that just in terms of the fact that a print like this, when you take a look at these numbers, pretty much does rule out any sort of aggressive measures that we could see from the Fed in 2025?
Yeah, I think with the configuration of the data, not just the labor market data, if you look at some of the other figures we've been getting, still very resilient consumer spending. The Atlanta Fed GDP tracker for Q4 is well above 3%. So there really aren't a lot of signs that we're getting sharp slowing, except the concerns are, as we talked about before, that the unemployment rate has risen. Some labor market measures have softened. So that's really where the concerns about activity are coming from. But given most of the data are screaming soft landing, I think the idea of getting very aggressive rate cuts is unlikely, especially as we were talking about earlier. You do have to be a little bit concerned about inflation as well. Inflation has come down a lot, but is still above the Fed's target, particularly on the services inflation side, which is what's most tightly tied to wage growth. So, putting that combination together, I still think you get more easing, but I don't think you get aggressive easing. I think the bar for aggressive easing is extremely high. Maybe a meteor would have to hit the earth, the U.S. economy. But aside from that, I think we're in for a relatively gradual easing cycle with these figures.
So then what happens to equities over the next 3 months, Steve? We get that cut in December, then where do we go?
Well, I think you have this honeymoon period that persists certainly through the end of the year. You could see the low level of VIX, and it's important to remember that VIX is not specifically a fear gauge. It's the market's best estimate of volatility over the coming 30 days. Well, there was really only the jobs numbers and the Fed meeting as major volatility inducements between now and the end of the year. So VIX has really dropped off. I think the big question, when you say 3 months, the big question sort of changes around 6 weeks from now is what happens when the new administration takes office? What might some of the tariffs be via executive order, that sort of thing? And that's That's quite a bit murkier, but that's not really priced in terms of the VIX 30-day calculation. I think right now, though, things are very frothy, but the trend is your friend. So it's a very hard market to fight.
Robert, how are you factoring in Trump's potential policies and the implications there? We talk so much about tariffs and whether or not they're going to be inflationary. We talk so much about budget cuts and just what exactly that is going to mean here for the economy going forward. What's your assessment?
Yeah, we just put out our 2025 outlook yesterday, where we kind of outlined a Trump base case, which is, there's a lot of uncertainty across a wide range of policy areas and kind of what do we expect within each. And the difficult thing for forecasting the economy is that Trump policies are a combination of positive and adverse demand and supply shocks, and sussing those out is very challenging. A good example would be if he does targeted tariffs, that would tend to lower growth and boost inflation. On the other hand, deregulation, which is another focus of his, tends to be thought to boost growth and be disinflationary in the short term. So I think it's very difficult to put all these together and say that inflation is going to be higher or growth is going to be higher or lower. It's going to depend on each of the factors. On balance, though, we do think when we look at all of the figures, on net, we're more worried about upside risk to inflation under Trump than downside. And I think that's another thing that points to, the Fed being relatively cautious, is when you net all these out, they're probably on net more likely inflationary than disinflationary.
And as Powell said this week, he's going to wait to see the impact of that policy and not kind of preempt any of it. Robert, thanks so much for joining us, and thank you, Steve, as well,
Pleasure.
for joining us to break down the latest jobs data. We appreciate it. We're going to send it over to Jared Blickery for a look at the movers on the back of that November payrolls report. Hey, Jared.
Hey, Maddie, it looks like risk on so far, and we're pretty early on here. And I should mention that a lot of times that we do get reversals of these moves into the trading hour as the day begins, but this is the initial reaction. I'm going to show you what's going on with small caps, because that is the biggest reaction to the upside, and we're seeing them up by about 86 basis points here. Those are Russell 2000 futures in the pre-market, and we can see even the Dow up just 13 basis points. It had been slightly negative before the report dropped, and now we are seeing a trade to the upside. And we're also seeing futures. We're seeing 2-year U.S. Treasury note futures. Those are trading up right now, which means yields are heading in the opposite direction. That would be down, and that's also supportive of the risk-on mood in the market. Those are the 2-year note futures. Here are the 10-year note futures. Very similar story, but I should say, too, these are not very big movements. We're still not seeing any kind of outsized reaction. And let's go to the gold market. Sometimes gold, silver, you'll see some reactions in the precious markets, in the precious metals markets here, not seeing much movement at all. Gold futures were already standing on some gains earlier when the report dropped, about 0.5 percentage point, and that is just not changing right now. And here's silver futures. Those are up 62 basis points, looking pretty similar to gold. I'm going to bet there's not a whole lot going on with Bitcoin here, but let me just show you ancillary. This is a market that has just been on fire, moving both to the upside and the downside by extreme amounts. I think it hit 92,000 or something overnight, and that was after selling off from 102,000. So big movements in Bitcoin, but that is not related to this jobs report this morning. And then let's get a read on the sector action. Consumer discretionary was leading before the report, and you can see most of the sectors in the green here. What is not in the green? Communication services and energy. And I just want to show you what's going on with some of the smaller issues. This is the ARC Innovation components. We're seeing Tesla, that's a big one, that's up, but also some of the smaller ones up, like Shopify, 3%, Coinbase, 1.5%. Just kind of speaks as to the risk-on flavor we're seeing being expressed through these smaller, not always profitable companies, Shauna.
All right, Jared, thanks so much for breaking that down. Coming up, we will have more on the November payrolls report and look at what sectors gained and lost the most jobs. Again, you're seeing futures moving to the upside on the heels of the beat that we did get on the headline number. To recap those numbers quickly for you, the headline number coming in 227,000. That beat the street's expectations. Unemployment rising slightly to 4.2%, slightly above the average estimate of 4.1%. Also remember that 4.1% was also the prior reading there for unemployment. And average hourly earnings there on a year-over-year basis rising by 4%. On a month-over-month basis, we did see a slight increase here of a rise of 0.4%. That was slightly higher than what the street had been expecting, I should say, of a rise of 0.3%. We'll be right back.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
The U.S. economy adding 227,000 jobs in November, 7,000 jobs more than expected. Unemployment rate ticking slightly to the upside here, up to 4.2%. Joining us now to break it down, we want to bring in Danny Romero. We also have Alexandra Canal joining us for a deeper dive into these numbers. And Ali, let me start with you because there's so many directions we could go with this report. But going into the print, there was lots of talk about strikes, how that had affected past reports, how that will be reflected this month. What's your biggest takeaway from the numbers that we just got?
Yeah, the strikes, particularly the strikes at Boeing, really impacted the October jobs report. A lot of noise there, but we saw that pretty much rebound this month. Manufacturing, that was one of the hardest hit sectors in October, but we saw that rebound, particularly in transportation equipment manufacturing in the month of November. Employment in that particular unit increased by 32,000 last month, reflecting the return of those workers who were on strike. That's according to the BLS. In total, the manufacturing sector added 22,000 jobs after losing 48,000 in October. Leisure and hospitality also trended up last month with 53,000 jobs added after we saw little change in the month of October. Employment did tick higher in food services and drinking places by 29,000. And if we look across the past 12 months, the sector has added an average of 21,000 jobs per month. So some relative strength in that category. But retail trade, that didn't do so hot. That lost 28,000 jobs in November after showing little net employment change over the prior 12 months. Now, in November, employment declined in general merchandise. That was down by 15,000, while electronics and appliance retailers added jobs. Now, this is not terribly surprising. Typically in November, we do see a pullback in retail jobs due to various seasonal factors heading into the holiday shopping season. We know a lot of retailers have been hiring earlier. We've also seen some shifts in consumer behavior when it comes to what they're purchasing. So I do expect that we'll see potentially a rebound in next month's job report. But all sectors to keep an eye on, especially as we've been tracking these strikes and the impact over the past few months.
All right, Ali, thanks so much for bringing us those numbers. Danny, we're going to kick it over to you. I know you've been following the construction data.
Maddie, it's not surprising that the construction sector added 10,000 jobs in November, a slight rebound from the previous month. Remember, there was a hiring freeze in October for construction jobs. Hiring fell to the lowest level since 2020, according to other government data. Experts say that the reason here was due to the election uncertainty and the expectation that borrowing costs would come down in the next several quarters, which would impact staffing decisions. But going back to today's jobs report, non-residential construction jobs saw a pullback last month, and the area that really saw a boost is residential construction jobs. This is an area that's a little bit more unpredictable. It gained 1,400 jobs last month, and remember, this is an area that has seen some pullback in residential construction job projects over the last year. But bottom line, experts tell me that they are expecting an increase in staffing in the next 6 months, specifically next year. So that means more hiring for construction jobs.
All right, Danny and Alexandra, thank you so much for joining us. We appreciate it. We're going to continue our coverage of the November payrolls report. We are joined now by Joe Brusuelas, RSM's chief economist. Joe, thanks for being here with us. I was here with you close to a year ago. You declared that we were in soft landing territory. What is today's print telling you?
All right, so today's print, it really corrects for the hurricane-induced October report. It's a little like fourth grade math class. What you do is you take the 227, you add in a 56,000 upward revision to the past couple of months, and then you divide by 2. What do we get? Well, we get 141,500. Guess what the 3 and 6 month trend was before the hurricane? 148,000. You know what? This is bang spot on. You know, we have a really remarkably calm labor market right now, ladies. If you take a look at the pace of firings, yesterday, you take a look at this hiring, remarkable stability here. That's what I really see in this report. It's an American labor market that's just moving along at full employment right? And I think that's the important thing here. We are at full employment. This is what one would expect. We need to hire between 100 and 150,000 a month to keep the unemployment rate and the labor market stable. What are we getting? Right around 148.
Joe, do you see anything that could put that in jeopardy?
Well, of course, right? There's always risks out there. My sense here is that we're going to get some big policy changes next year. That might take the edge off of it, because if the tariffs are outsized, yeah, it would make sense for big corporates to begin to pull back, because that's where you're going to see it. Now, when you look at the report, well, I think what we're getting is small and medium-sized businesses are hiring, but the big ones have stopped, I think, in anticipation of some of these changes. Moreover, again, just to touch one thing here, the job losses in October were largely in Washington and Florida, where the storm was. We could see in the claims data for the last couple weeks, it came back. Danny made a really interesting point there around construction. I think it actually understated the rebuilding that's going on right now in the Southeast. I expect those construction jobs to be revised higher in the next couple of months. So we're in a pretty good place. Now, longer term, there are some issues in the labor market that I think we probably want to address here, because nothing's perfect forever.
Well, what are those biggest issues then? I guess we've talked a little bit about the inflationary pressures that you could see from wages, but underneath the surface, I guess what is most concerning?
So the median duration of unemployment is about 10 and a half weeks. Most people who lose a job, they find one within 3 months. But we are beginning to see people who are unemployed longer than 15 weeks or 27 weeks. There's some issues there. A full 40% of those who are out of work and actively looking now been unemployed longer than 15 weeks. 22% of those are facing longer bouts of unemployment. Now, typically it's a matter of friction. There are personal issues out there. There's some discrimination that's always there in the market, especially around older folks, I think. But the 800-pound gorilla in the room is technology beginning to create some unemployment? What economists would kindly call technological unemployment. It's what everybody worries about, artificial intelligence. Now, we just don't know. But my gut tells me we're probably on the outer edges of that. And that might be why there's some redundancies out there in the workforce, and why people are having a hard time finding jobs, because some of their skills now are not really necessary because what we can do with artificial intelligence.
What you're talking about is so critical for listeners to understand. I think, Joe, especially as you have a Doge group coming into the Trump administration that's going to focus on using tech to create more efficiencies. What does that do to the Fed if we do start to see a weaker labor market because of increased efficiency due to AI?
Okay, so if you're an investor and you see that, the Fed clearly would move to cut rates. Now, I think today's report does support a 25 basis point cut at the December 18 meeting. But I don't think we're going to see any more action until March of next year at the earliest. But over time, the Fed's going to pay very close attention to technological unemployment. I remember Ben Bernanke years ago, before this US Senate, talking about this very thing. And the senators looking at him like, what is he talking about, right? Oh no, they're well aware of this over at the Fed, and they've been thinking about this for a very long time. And they would move to accommodate if that's the case. But I want to be really clear here. We don't know right now enough to categorically state that's it. But my gut tells me we're about to reach the point where we ought to start thinking about this a little more.
Joe, what is the most critical, looking forward, as we look ahead to next year? We talked a lot about Fed policy. I guess in your view, what is that most critical data point or report that investors should be paying attention to that really will give us the best sense of where the economy stands? Because we go back and forth all the time.
This is where I'm really glad I'm on Yahoo Finance today, because we can get a little technical. We can start throwing out some jargon. They need to begin looking at critical bond spreads that are proxies for leverage and liquidity. Now, since the election a month ago, I've spent a lot of time talking to my professional network, the cats who work on bond desks, repo desks at the systemically important financial institutions, i.e. the 5 major banks. They are beside themselves. They're giddy. They expect leverage to work back into this market, to flow through to the big companies who are then going to begin to expand their operations. I mean, this is going to be a very heady time if you work in financial markets. So that's what I really have my eye on, because the seeds for a financial expansion are all there: the light regulation touch, taxes coming down, the way in which tech and energy are likely going to really benefit from the new policy framework. So those are the things that I'm looking at with respect to at least the domestic economic outlook. Now, the global economic outlook is very different. You had a global economist on here from Citi, taking a look and say over in Europe, they're going to need to get aggressive with their cuts. That economy is stagnating, and they do not have the time to wait. So it's going to be a tale of two cities next year in the global economy, the United States and Europe.
It'll be interesting to watch how this all plays out. Joe Bruce-Wallace, always great to get you, especially here on Saturday like today. Thanks so much.
Happy holidays, everybody.
Thank you, you too. All right, well, before we head to break, let's get a check on the market action. Taking a look at futures, you're seeing some gains here across the board. It looks like all three of the major averages on track to open the trading day in the green. Flipping over to the bond market, we're seeing some movement there, a bit of a pullback here in yields. You got the 10-year yield right around 4.16, and then flipping over to the dollar, we also did see a bit of a drop there on the heels of this print. You have the dollar index pulling back just a bit. We got much more on the jobs coverage ahead. That's coming up next on Yahoo Finance. It's 9 a.m. here in New York City on this Friday, December 6th, the Jobs Day. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Madison Mills, and let's get you guys the 3 things that you need to know this morning.
First up, the November payrolls report coming in hotter than expected. U.S. stock futures jumping on the back of the numbers, which showed 227,000 jobs were added last month, slightly higher than Wall Street had been expecting. October's jobs print was also revised higher from 12,000 to 36,000.
Plus, Bitcoin pulling back from its record highs. The digital asset trading below the 100,000 mark here this morning after hitting a low of $92,000. Here you have it just below 99,000. Still, though, Wall Street strategists expect the token to rally into the new year. And derivatives market pricing for January showing the highest open interest for Bitcoin options with strike prices of 110,000 and 120,000 that expire at the end of the month.
And Donald Trump tapping venture capitalist David Sachs to be the White House crypto and artificial intelligence czar. In a post on Truth Social, the president-elect said Sachs will guide policy for both of the industries. The new post is expected to help spearhead the crypto industry deregulation that Trump had promised on the campaign trail. Meantime, former U.S. Treasury Secretary Larry Summers casting doubt on Trump's idea of a national Bitcoin reserve. Summers dismissed the idea of the government setting up a reserve of Bitcoin assets in a Bloomberg television interview, calling the idea, quote, crazy.
Futures are pushing higher after the November payrolls report came in hotter than expected. A bit of a better print here. We want to bring in our very own Josh Schafer for more on the market reaction. And Josh, there's so much to dissect and dig into this report. But Maddie and I have been talking for the last 30 or so minutes and focusing in on what we got average hourly earnings and the wages there, what ultimately that's telling us, because that did come in maybe slightly higher than what forecasters have been expecting.
Yeah, so average hourly earnings coming in at 4% year over year. That's unchanged from October. And largely, I think this is a big part of the story, guys, because the narrative coming into this jobs report essentially was if we got about in line print, which I think looking at our screen right now, 227 versus 220, 4.2 versus 4.1 on that unemployment rate, but some had been predicting 4.2. I wouldn't say that's largely unexpected to see unemployment rate come up. But really the narrative was, okay, if we get about an inline print, CPI is going to matter a lot more to the market next week. And when you look at this consistent wage growth that we're seeing and the fact that that number isn't coming down, and you're talking about this last mile of inflation being sticky, it seems like something we're going to be talking more and more about going into next year. And again, I think it just makes, when we're thinking about what are the risks to this December rally, we kind of just keep talking about stocks are drifting higher every day. Stocks are drifting higher every day to end 24. Well, what could be the risk? It feels like now your risk is probably that CPI print, because it seems like the CPI print would maybe drive, that would be the catalyst to maybe have the Fed not cut in December. It doesn't seem like the jobs report today is moving the needle in terms of that argument, but maybe the inflation print next week does. And even if it doesn't next week, it gets into that whole discussion we've been having about maybe the Fed doesn't cut much in 2025 or at all, right? This wage growth story is a large part of that.
It seems like the market is really running with that 4.2% unemployment rate number as, evidence that the Fed continues to have that justification to cut. And yeah. I wonder how the inflation print, how much that could potentially change that narrative.
Yeah, no, it's an interesting point, Maddie. And the other thing, too, that I'll bring into this conversation from data that was out Wednesday, I was talking to ADP's chief economist, Neil Richardson. She was pointing out to me in their wage data growth right now, so if you took their private wage growth that they're looking at and you looked at CPI, wages are actually only pacing, per their data, about 30 basis points higher than CPI. That's a very narrow margin, right? And so what that means is we talk a lot about, well, at least wages are growing above inflation so the US consumer can keep spending, right? And that's part of why we have this good economy. That margin is actually slimming too, because inflation isn't moving down that much. And at some point, if the general American consumer is barely making more money than the pace of inflation, you wonder about the overall trajectory of the US consumer going into next year. That's a part of this story as well, if inflation doesn't keep coming down and sort of stays in this sticky range. But it does, I think overall, today's report reminds us that while we were talking about the labor market a lot in the summer, inflation seems to be the main print again and the main narrative that we're going to be talking about with the Fed leading into that meeting on December 18th, but also going into next year.
Yeah, Josh, and I think that's such a great point here for investors and for our audience really to understand, because we have been going back and forth just about what print matters most and where investors should be paying close attention to, right? And clearly they both matter, because we wouldn't be having this reoccurring debate every other month just about what we should be paying close attention to. I'm curious, just from your assessment so far, the number of strategists that you talked to, economists, just how they're factoring in the unknown variables at this point when it comes to Trump policy, when it comes to what is likely, the timing of that. Like, how much of that do you think is playing into this narrative, and how policymakers are also trying to figure that out?
Yeah, so when you bring in Trump policy, right, obviously sort of the consensus broad take would be his overall policies, including things like tariffs, are expected to be a little bit more inflationary, right? That's sort of the overall high level take. Mm-hmm. The question is it inflationary in the first half of 2025, the second half of 2025, or do we not actually see that until 2026? That's one of the hottest debates right now. I don't think anyone really has a good answer because we're not really sure. But I think overall, if that is what leads to the Fed not cutting, that isn't something that people are necessarily worried about for the stock market in 2025 right now. Mm-hmm. It is, if the Fed is not cutting because, as Jay Powell just said 2 days ago, and I don't think this jobs report would necessarily largely change his opinion, the U.S. economy is in pretty good shape right now. If they're not cutting and the U.S. economy is in pretty good shape and they're waiting for inflation to come down, a lot of people would argue that's still a good opportunity for something like cyclical stocks. That's been a popular call we've been talking about going into 2025, right? Maybe something like financials, one of those sectors. And I think that call still remains whether we get further into this Fed debate about inflation. It seems like that is still something people feel confident going into 2025. But again, the unknown of the Trump policy, Shauna, definitely is the biggest question still looming.
Yes, and it's hard to figure out exactly how, what it's going to look like, obviously. All right, Josh, thanks so much. Let's turn now to the focus of the Fed here. Our next guest saying that it's actually the central bank's inflation battle now falls in their hands. Joining us now, we want to bring in Brian Jacobson. He's Annex Wealth Management Chief Economist and Strategist. Let's talk about exactly what that means here for the inflation battle falling into the Fed's hands. When you see an average hourly earnings print like this coming in slightly higher than expected, we have inflation remaining very sticky. What should the Fed do at this point?
Yeah, thanks for having me. So here at Annex on our investment committee, when we were looking at this morning's report just a little bit ago, it really is one of these things where it's not necessarily a Goldilocks report. It's more like a little engine that could report. As far as just the economy, it just keeps moving along, keeps climbing that hill, that wall of worry. And now it's really up to the Fed as to what are they going to do with this data. They have no idea where they actually want to end up with the federal funds rate. And so they don't know the destination, but they do know that the journey to get there includes more cuts. How many more and over what time frame? It's quite likely that they're going to cut in December at the next meeting, but then shift to a cadence of every other meeting in 2025 because they want to tread a little carefully here. They don't necessarily know how the economy is going to react with the cumulative effects of the rate hikes that they had. Even though they're cutting, they haven't really cut a lot. So I think that really they made a lot of mistakes along the way, but thankfully, American consumers and American businesses have really just kept chugging along ahead to make up for those mistakes.
I want to zero in on the consumer with you for a second because we're seeing small caps rallying this morning, beating out the moves that we're seeing in large caps. And I wonder if that's the market telling us that there's this bet on increased consumer spending that's going to fuel some more growth in those smaller and mid-sized businesses. If we do see that increased consumer spending, though, doesn't that tick up inflation and therefore lead to a Fed that has to be more hawkish? What does that look like to you?
Yeah, quite possibly. I think that the immediate reaction here that we're seeing is that with lower yields, a lot of those smaller cap companies, they have higher debt burdens than the larger companies. And so you can get a little bit more of that relief. So if this almost locks the Fed into continuing along that path of gradual rate cuts, that should provide some relief to small caps. The burst that we could get with consumer spending, if we get a little bit more optimism now that we have the election behind us, and granted, we've traded election uncertainty for policy uncertainty, but consumers seem to be at least saying they're feeling a little bit better. So if we see some acceleration of consumer spending, that should hopefully redound to the benefit of small caps. So we have an overweight to small and mid-cap stocks for that reason, because we do think that it's not necessarily going to reverse course for the Fed, that we can see that improvement in consumer spending, but they're still so price conscious that they are very quick to shift to other retailers and other suppliers if they see prices moving higher than their wages are.
So then, Brian, when you take a look at a print like this, when you take a look at the expectations going into 2025, I think many investors are out there asking themselves whether or not this rally that we have seen, whether or not it has room to run, whether or not it can be sustained. When you take a look at a print like this, is that enough to continue this risk-on move to the upside?
I think for now, right, as far as do we then get some sort of pullback maybe in January as people reassess where are they with their portfolios? Sometimes if you think about, all right, if you had something that you bought at the beginning of January, now you get a year in, it's a long-term capital gain instead of short-term. So you can get some of that volatility, I think, as we get into the new year. And a big question in my mind is the sequencing of threats and policies from Trump. When he, in his first administration, he threatened tariffs and then implemented them when he wasn't getting his way. Now, is he going to come out instead and impose the tariffs and then promise to remove them if he does get his way? So I think that if we do a Trump who is a little bit more coming out of the gates swinging with actually imposing the tariffs, that could come as a bit of a shock, because I believe most people are thinking that you should take him seriously, but not literally. Well, at this point, where we are with valuations and the market run, I'd say maybe start taking them a little bit more literally.
So then what do you do with that, particularly given that you've got a Fed that is going to be cutting, at least if you look at what the market is telling us, but we have long and variable lags from those cuts, and also that policy is going to take time to actually get implemented. Which of those two is going to win out as the driver of the markets, the fiscal or the monetary policy?
I think that for 2025, it's really going to be uncertainty around fiscal policy, because they are likely going to take a good chunk of the year trying to figure out that budget reconciliation process, as far as, you know, all the horse trading that takes place in order to extend ultimately the Tax Cuts and Jobs Act, but what else gets thrown in there and modified perhaps. So I don't think the fiscal picture is going to become very clear. What is going to be clear, I think, is more the monetary policy side, continued gradual cuts. And so if the monetary policy, the cutting of rates really trumps the fiscal policy side, that should serve as a fairly favorable backdrop for risk assets, but it's not going to be without its risks along the way.
All right, Brian Jacobson, thank you so much for joining us. We appreciate it.
Thank you.
It's time now for some of today's trending tickers. Meme stocks still on the move today after the rally was sparked by stock influencer Roaring Kitty posting a cryptic message on X with a picture of a Time magazine cover that appears to resemble a 2006 issue that featured you as the person of the year, literally you. The post sent shares of GameStop, AMC, Unity Software, ticker U, and Clear Secure, ticker YOU, soaring yesterday. But taking a look now at AMC, those shares are moving to the downside. Now, part of the reasoning behind that I am anticipating is that we saw AMC dropping on this filing to sell up to 50 million shares today. We've seen them consistently waiting to offer these share sellings after Roaring Kitty posts. This is not the first time that AMC has done this, and we've consistently seen a negative share reaction off the back of that. But it's also no surprise to see Roaring Kitty potentially posting about this kind of meme stock rally in anticipation of those GameStop earnings coming up. Perhaps there is some movement ahead of those earnings.
Yeah, we certainly have seen, once again, him invoking some excitement within these trades. You mentioned the pullback that we're seeing in AMC here this morning. Again, that's on the back of a nearly 6% climb that we did see yesterday, when we did see more and more money start to be poured in to some of these meme stocks amid the speculation. And once again, Roaring Kitty, time and time again, when he doesn't post very often these days, so that is why it's so significant and does tend to move the market the way it does. But we do tend to see a reaction given his following that he has been able to really accrue over the last several months and several years when you go back to the start of the meme stock craze. So GameStop, we saw a lot of volatility. We saw the stock halted briefly yesterday. We're seeing some a further push into some of these select meme stocks here this morning, with GameStop up another 2% here ahead of the open. But you could send yourself around spinning in circles trying to figure out exactly what some of these some of his posts ultimately mean and what he is trying to signal. that doesn't stop anyone. There's so many theories out there just on ultimately what this all signals going forward for the meme stock tree. He certainly has a lot of loyal followers, given that success that he did see a few years ago. But once again, I think this also just points to some of the froth that's in the market. When you take a step back, take a look at valuations where they are today, take a look at Bitcoin hitting that record high yesterday. We're now just slightly below 100,000. I think that really just speaks to just that overall sentiment, that risk on sentiment. And obviously you can draw some parallels, although very, very different. You can draw some similarities to what we saw a couple of years ago.
Yeah, and then you've still got that $7 trillion in cash on the sidelines that could come in and increase that froth even more, even further. So certainly a lot of bullishness and momentum to go around here. Coming up on the morning brief, we're going to count you down to the opening bell on Wall Street after a better than expected payrolls print. Plus, as we await a federal court ruling on the ban of TikTok, the potential ban of TikTok, we're going to look at the stocks to watch around that decision. And on the other side of our break here, Acting Labor Secretary Julie Su gives us her read on the state of the labor market. We'll discuss that and much more on Morning Brief.
Welcome back to Yahoo Finance Live from the Labor Department here in Washington. I'm Jennifer Schonberger. The labor market rebounding in November after being slammed by 2 hurricanes and a worker strike at Boeing in the month of October. That non-farm payroll number bouncing back to the tune of 227,000 jobs versus a revised 36,000 in the month of October, though the unemployment rate ticking up 0.1% to 4.2%. For more insight on this morning's report, I want to welcome into the program Acting Labor Secretary Julie Su. Secretary Su, thanks so much for joining me. It's always great to see you.
You too, Jennifer.
So we saw a rebound in the job market in the month of November, quelling any fears about further weakening in the job market, though we did see an uptick in the unemployment rate to 4.2%. To what do you owe that?
So this is another example of this really historically strong economic recovery and the transition, as we've been talking about for some time now, to steady and stable growth. Last month we said that the hurricanes and the fact that there were tens of thousands of workers on strike affected the number, and this month landed exactly where we expected it to land. The total number of jobs created have been unprecedented under this administration. In fact, it's the only one that has seen job growth every single month in the entire time that a president has been in office. We're very proud of that. We're handing off the strongest economy in history to the next administration. The unemployment rate at near just above 4% has also been very, very consistent. Defied expectations, but very, very consistent. So it is up slightly recently, but since the summer, it's been between 4.1 and 4.3%. And what's important to note is even with a slight uptick, the labor force participation rate is incredibly high. It's like at a, for prime age workers at a 20-year high. Normally, when you see more workers in the labor market, you see, bigger bumps in unemployment. That has not been the case here. And so, again, like by all markers, this is a jobs report that we're proud of and an economy that we're really proud of.
But we did see the labor force participation rate actually tick down again for the second month in a row. Any thoughts on that? And the fact that we did see the uptick in the unemployment rate to 4.2%, is that a recognition that more people are trying to join the labor force, and that is why the unemployment rate went up? Or do you expect that that will continue to drift upward in the coming months?
So there's been a trend in terms of the overall labor force participation rate because of older workers, right, of sometimes a slight decrease or steadiness. For the prime age workers, it has been very steady for a very long time. And that means people are, feeling positive about the labor market. They're coming in, they're looking for jobs, they're finding them because of the large number that have been created, and they're making more in them, right? Let's keep in mind that wages are also up, and the rise in wages has outpaced inflation for months now. And so we're seeing wages on the rise and inflation going down, another marker that when you prioritize the well-being of working people in an economy, it does make a difference.
Looking at the retail sector, we did see retail jobs fall by 28,000 last month. Thanksgiving was later this year, which meant that Black Friday and the start to the holiday shopping season was later this year. How much of that downdraft do you think was because of a later start to the holiday shopping season versus demand for workers being lower because of inherent lower demand by retailers and a weaker economy?
Yeah, I don't think it's a weaker economy. I do think there have been, we've been seeing a transformation in the retail industry, right, for some time now, but certainly online shopping is a part of that, because at the same time that the retail employment numbers are what they are, we're still seeing record, consumer activity, right? Black Friday has been reported to be the most activity in a long time. And so people are buying things. They've got some of that disposable income to do so. But the nature of how people shop, I think, has been changing. And, we're going to need to look over the next month also to look at retail, because this is a noisy period of time, right? The holiday shopping season does affect what happens in retail, and we'll need to look at another month to see if that's a real trend or just an aberration.
Speaking of trends and overall trends in hiring, we've seen that cooling. However, we haven't been seeing mass layoffs. Economists are calling this the no hire, no fire economy. What's your sense of that notion?
I don't know if that is more in comparison to, remember, there was a time, certainly in 2022, where there was so many jobs being created and a tight labor market giving workers more power to choose. So many of them were leaving their jobs to get better jobs, right? It wasn't that they were being laid off. It wasn't that they were leaving the labor market, which would have been signs of a weakening economy. All of the pieces put together were signs of a very strong economy. I think the same is true now, right? This is a period of greater stability. People are settling in. And so, again, of the jobs that we've created, of the jobs that are growing, it's no accident that many of those are also in industries that we've said, if we build a stronger economy where we prioritize workers and their wages, then those industries also become stronger too. And so we're just, I think, seeing some more stability, more leveling out.
We know that immigration is also part of this story. The forthcoming administration has talked about mass deportations. Of course, we don't know when and to what extent that policy could be implemented, but if we were to see a drastic drop in immigration, what impact would you expect on job creation and wages in this economy?
Yeah, I mean, that's one of those, sort of, I guess, campaign promises that really have put some, real fear and insecurity into communities. And by most accounts, it is something that would be very harmful to the strong economy that we will be handing off to, there. Part of the growth in this economy has been fueled by, immigrants who have long helped to strengthen our economy, to do critical jobs. And so, I'm not going to predict what is likely to happen, but I do think that, cruel and inhumane policies are inconsistent with building a strong economy.
this administration has done a lot for unions, organized labor. President-elect Donald Trump is looking to put forth as his labor secretary Representative Lori Chavez DeRemer, who is a pro-union Democrat. Does that give you confidence that the reforms that you've made surrounding unions will remain intact in the next administration? And have you talked to Chavez DeRemer?
So she and I have exchanged messages. I certainly want to be as helpful as possible in ensuring a smooth transition for her. I care deeply about the department, and one of the things that we have seen in this administration is that when the American people deserve a very strong labor department that is true to its mission, that understands that when unions are strong, workers are strong, but that also a large majority of American workers are not in unions. And so the Department of Labor stands as a really important defender of their rights, of enforcing basic labor laws. We put $1 billion into the hands of working people just who experience wage theft. That means you go to your job and at the end of the day you don't get paid what you were supposed to be paid. That is a break of a fundamental law, and it's the responsibility of this department to enforce it, right? To make sure that that's not happening. We, saw a decrease in this administration in the number of injuries on the job, fatalities on the job. I think those are examples of when the department is strong, when employers know that there is going to be enforcement if they choose as a business model to break the law. There are good results from knowing that there's going to be consequences to law breaking, right? So having a strong department is so important to all of that. And the most important thing is there are 15,000 career civil servants who work at the Department of Labor who believe in the mission and come in to do that work every day. And I believe that they will continue to do that.
Secretary Sue, we'll have to leave the conversation there, but thank you so much for your insight as always. So appreciate it.
Thank you.
That's Acting Labor Secretary Julie Su. We will be right back after this.
We are just about 20 seconds away from that opening bell ringing on Wall Street. You're taking a look on your screen at the Nasdaq and the New York Stock Exchange, where we will be seeing that opening bell in just about 10 seconds here. I want to take a look, though, at the market reaction to that November payrolls report here, coming in just above the whisper number of 216,000, coming in at 227,000, and we're seeing a positive reaction in the equity market here on the back of that jobs print. You can see here in the futures market, the Nasdaq and the S&P 500 continuing to move to the upside. Also a little bit of movement in the Treasury space as we have this idea that the December payrolls number that we got in today for November is indicative that the Fed is not going to necessarily be able to cut too much too soon, and that could put a cap on yields here. I want to see if our Nasdaq has updated for the day. You're taking a look at gains of about 0.2%. The S&P 500 also moving to the upside. And I'll wait a second for the Russell to update as of the market open this morning. You can see here the Russell was under pressure yesterday. I think it's going to be really interesting to watch the Russell today because we saw the Russell beating the large cap names as of this morning on the back of that jobs print, perhaps in the idea that consumer spending moving to the upside could lead to a rally in some of those smaller business names. Again, though, the question being if the Fed does have to keep rates higher for longer, that could be putting some pressure on small caps moving forward. So that's going to be an interesting index to watch moving forward today. Again, you've got your S&P, your Nasdaq, and your Dow all moving to the upside off the back of that jobs print. And you can see here a little bit of the movement to the upside I was talking about in small and mid caps. If you take a look at the S&P 500 equal weight beating out the broader S&P so far in the trade this morning. Let's get over to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, thank you, Maddie. I'm going to put a 3-month chart of the S&P 500 on here so we can see we have now had it up 11 of the last 13 days, so only 2 down days, and basically it's been on a tear since the election there on a number of occasions, breaking to new highs, and we've seen this in other markets as well. We've seen the Nasdaq Composite come back to record highs, and the Russell 2000 just kind of eludes traders right now, those new highs, but you got to think that eventually they'll catch up and we'll be able to say a record closing high for the Russell 2000, something we haven't been able to say for a few years. 10-year T-note yield is marching to the downside. This is supportive of the risk-on rally after the payrolls report. We got those hot wage inflation numbers, but that may be counteracted by that increase in the unemployment rate. Here, the 10-year T-note yield is now off quite a bit from those highs of 4.5% that we saw only a few weeks ago. U.S. dollar looks like it's up now, had been down earlier, but not making too much of a fuss for traders. And in the early goings, we are seeing some cyclical action here in consumer discretionary and industrials and materials, but also consumer staples. So that's a defensive sector. That's number 2 up here, XLP. And we can see on a year-to-date basis that is not quite at record highs, the ones that we saw in September, but it's still holding on to gains of about 15.5%. But I want to focus on the Mag 7 right now. The Mag 7 index, not shown here, has been hitting record highs for several days in a row. Today would be the 5th. I don't think it's there yet because we're seeing a mixed board in those bigger numbers, in those bigger issues that you can see to the left. And Apple, Microsoft, Alphabet down just a hair. Microsoft flashing green now. But Tesla is the outperformer of the group. Tesla up 1.47%. I'll put a 5-year chart so you can see climbing steadily back towards those record highs that we saw in 2021. So investors getting excited about that. And I also want to take a look at Microsoft. Here's a 5-year chart. I'm going to dial this down to a 1-year so you can see that we are breaking through this resistance area. Had been stuck in a trend channel, just going sideways for a number of months. Now it's breaking to the upside. And will it continue on? Will it be the next Amazon, which recently broke to record highs itself? So that's kind of the blueprint there. Want to focus on some of the smaller issues. You know, we were talking about the small caps and are they going to catch up? Well, we've seen a lot of the fringier parts of the market. That includes the ARC innovation components that you're seeing behind me. That's unprofitable tech. Tesla is profitable, by the way. It's also a very big company. But if we look at the equal weighted version, we can see some of the leaders here. Shopify up 4.5%. Coinbase has been on a real nice run along with Bitcoin. And let's just end on Bitcoin. You can see it's down 3.14% right there. But really interesting, on Twitter, on social media, I'm seeing traders call this the Darth Maul candle, that red candle right there. If you squint, you can see it. If you know the Star Wars trilogy, or I don't know how many they have now. But nevertheless, I promised we'd end there. Crypto, a little bit of a downdraft for the morning.
Wish I could weigh in on that, Jared, but I'm far from an expert in that. All right, Jared Blickery, thanks so much. It's time now for today's strategy session. You got President-elect Donald Trump tapping venture capitalist David Sachs to be the White House crypto and AI czar. So what does this mean for the industry? We want to break it all down with Frank Spicer. He's Metafi's CEO. It's a predictive trading platform that actually sees Bitcoin getting to $250,000 by the end of next year. So a lot to unpack here this morning, but I want to start there with the lead, and that is David Sachs here being appointed this crypto and AI czar role here in the incoming Trump administration. Does that make you even more bullish on what the potential is here for Bitcoin over the next 12 to 13 months?
Yes, it does. It signals a shift to being hospitable to crypto innovation. And in general, just the concept of its viability as an asset class. I think it's a full vote of confidence from the administration, something the founders in the industry have been looking forward to for a long time. And everybody I've talked to is super bullish, almost unanimously. I don't think I really got anybody that is saying that this doesn't mean great things for the industry. And I think, that 250 starts to maybe look a little conservative if a few things click for the industry here.
Then what could be then more realistic? Are we talking 300? Are we talking 260? I guess give us a better sense.
Yeah, you can see 275, 300 if the rest of the world begins to adopt it as a viable hedge against inflation and an alternate settlement mechanism. There's really no reason why the price floor needs to be there. There's only a few million circulating Bitcoin. If you look at the historical chart, there's 21 million that will be in circulation, but there's about 15 million that are locked up right now that don't really move. So there's a limited supply and a growing appetite from large ETFs and nation states to soak them up. So I think that means a competition for the remaining Bitcoin on the market, and that pushes prices up.
But Bitcoin is down today, Frank, and there was this kind of idea that once they hit that $100,000 psychological level, we would see some profit taking, but we didn't see it right after we hit 100,000. What does today's move tell you, and is it part of a broader story here, or is it something simple?
Yes, actually. So this right here, what we're seeing is inexperienced traders taking long positions on Bitcoin and being taken to school by professional traders. I think what happened is people decided to as the rally was running, to take long positions if it wouldn't retrace, it was going to just blast to new highs. But that's not the way that the industry works. That's not the way the asset has ever worked. And over the past 24 hours, you've seen almost 1 billion in liquidations of BTC positions.
Frank, when it comes to, I guess, just the potential here, you talk about the key psychological level of 100,000. And I guess if we do see institutions and then potentially government continuing to buy in beyond this, and you have this appointment of David Sachs, how much does that just totally reshape the crypto market and maybe what is to come and make some of these regulations even more realistic or more probable?
I think it means great things for exchanges based in the United States, so they can start to bring these projects to the general audience and retail investor class. I think it gives exposure and a pathway for investors to see, okay, this project can develop, I can bring it to market. The United States starts to look like the way you bring projects to market, instead of being essentially radioactive over the past few years, where if you're a founder in this space, you were taking a real chance. Mark Andreessen was just on Joe Rogan explaining how he's had 30 founders debanked in the past, 3.5 years, just for being associated with crypto. And I think that all goes away. And instead, what you do is you see a return of innovation, which is what the United States leads the world in, and what we're best at.
I want to get your take on some conversations we've had here at Yahoo Finance this week with individuals who've both had to really stay the course during the crypto winter here, and that's Michael Saylor and Anthony Scaramucci. Let's take a listen to what they had to say about the Bitcoin rally.
Just keep buying Bitcoin with your spare capital. It's going to appreciate against the dollar forever.
This milestone is important because I think it tells people that Bitcoin's probably ready now for prime time institutional investing.
What an incredible backdrop for Anthony Scaramucci there. But, okay, are we really out of the woods when it comes to any question marks about the validity of Bitcoin, Frank? And I get that that's the question that every Bitcoin stan hates to hear, but I think there are going to continue to be people who remember the FTX collapse and still have questions about whether or not this really can come out of retail and be an institutional investment vehicle.
So I think if you fork the question here, yes, we're out of the woods in terms of its recognition as a viable asset class from professional investors, but we should not consider ourselves out of the woods for volatility, because the asset doesn't work like an equity, and it is subject to liquidations and things that typically don't impact stocks in the way that people might traditionally invest in them. So you're not able to look at it like a stable asset that has hundreds of years of precedent as stocks or equities do. But I think what we'll see is not just more of a better policing of the projects that come onto the market, but I think we can look forward to now U.S. exchanges such as like Coinbase and Kraken and Crypto.com, folks that bring projects to the retail investors in the States here, vetting the projects and taking projects with long-term viability. And once those sort of move into the market, and you're not just chasing these meme coins and meme tokens that are just ridiculous in my opinion, you'll start to see real value creation, a real generation of returns for investors. But Bitcoin itself is going to be subject to swings, and I think you'll see that through the next 2-3 years before it starts to finally mature when it's 3 or 4 times the price that it's currently at.
All right, Frank Spicer is the CEO of Ametified. Thanks so much.
Thanks a lot.
It's time now for our chart of the day. Let's take a look at just how expensive this current market is. This is a chart looking at the cyclically adjusted price to earnings ratio of the S&P over time here. You can see nearing record levels that we have not seen since the 1929 bubble. That was that Black Monday, heading into Black Tuesday as well on Wall Street. And then we have the tech and media telecommunications bubble, the dot-com bubble, heading into the early 2000s as those prior highs for this chart here. And then you can see at the end, we are ticking up to historic highs as well. So what does this tell us? It tells us what we've been talking about nonstop over the past year, that the market is incredibly expensive and valuations are stretched. The question for investors, does it actually matter, right? We've been hearing from investors all morning, Steve Stogdick included, saying don't fight the momentum, don't fight the tape moving forward. Another quote I love from this morning, expensive stocks, they can always get more expensive, particularly when you look near term. And that's something that we spoke with Max Kettner from HSBC about this week. He sees the S&P going up between 5 and 10% in the first 6 months of next year. We've continued to get increasingly bullish price targets in as folks are doing their 2025 outlooks across the street. But the big question is the risks in this market, not only globally with geopolitical challenges, but also domestically with the incoming Trump administration. Could there be any fiscal policy changes that could outweigh the monetary policy as the bigger driver of this market? We do have the Fed kicking off their rate cutting cycle. They are expected to have that December rate cut. But then we've had folks this morning tell us it could be in every other meeting. They could skip in January and then cut again the next month. How will that impact this market that is stretched when you look at the valuations? Again, though, I would point to some of the commentary we've gotten from experts this morning saying don't fight that momentum and just go along for the ride.
All right, guys, coming up, a judge is expected to rule on the legality of the TikTok ban passed earlier this year. We will be taking a look at some of the other companies that could benefit from the ruling. That's coming up next. A Washington judge is expected to issue a ruling today on whether or not a potential ban of TikTok here in the U.S. will go forward in January. TikTok's parent company ByteDance arguing that the ban would be a First Amendment violation. Its supporters saying that the Chinese-owned app poses a national security risk. I want to bring in Rohit Kulkarni. He's Roth Capital Partners Managing Director and Senior Research Analyst for some of the companies that could potentially stand to benefit here from this ban. So, Rohit, lots to unpack here. Let's start with who plans to, or who is in best positioned to benefit. If we do see this blocked, if we do see the need here to divest come January, what are the top three plays then for investors?
So a lot of scenarios here that could unpack over the next 30 to 45 days, and Trump and Musk further complicates those scenarios, in my opinion. But near term, let's just stay focused through the year end. If the judge upholds the ban today or over the next few days, the social media players in the US are clearly directly to benefit, in particular Snap and Facebook or Meta. Those are the companies with the most overlap of the number of users and advertisers. So I would expect shares in Snap to rise the most, and then shares in Meta to rise as well. But having said that, what happens in January and what happens to TikTok's stance as far as appeals and the next steps in the legal process, that remains to be seen. That's what further complicates the scenarios, and whether Trump and Musk together, how they work with TikTok in the future.
I'm curious, Rohit, how much you are anticipating the Trump administration to really be able to do on this. I mean, this had bipartisan support. This is obviously happening today prior to Trump being back in office. What if this is kind of much ado about nothing? It's kind of already done.
Hard to predict, to be honest. What I think is the TikTok could just become kind of a negotiating ping pong between Trump and China to a certain degree. It could set the tone in terms of how certain digital assets from China are perceived by US capital markets. And TikTok is not just the only one. There are other companies such as Temu, such as Shein, and various different other factors that could start to be put on the negotiating table, if you will, as Trump puts this in a bigger kind of scheme of things. So that's where it starts to complicate things. And if you think of Musk that who owns Twitter and is kind of supportive of various different things that social media should be doing, and TikTok is probably in that sphere as well. So I know many unknowns here, but in my opinion, there's a scenario that TikTok would still be around come 1st of February, working alive and well in the US. So there is that could again reverse some of the gains in the social media stocks that we might see.
Rohit, when it comes to just this back and forth and uncertainty just about whether or not it's going to be banned, what exactly the future looks like even beyond here the next year or so, it's a company that its parent company ByteDance was recently valuing itself at just around $300 billion. Does that at all cap the upside that we could see here going forward, just in terms of that growing valuation, or how should investors be thinking about that?
Yeah, absolutely. I think the new money that could be looking at a company like ByteDance is going to be staying on the sidelines, in my opinion, until there is a clear resolution of what happens to TikTok and its future in the US. Until then, probably there is almost no growth in ByteDance's valuation, despite what they may be doing outside of the US, outside of TikTok, and the core Chinese app that is kind of the sister app of TikTok in China. So obviously ByteDance would also be looking forward to a more quicker resolution, in a resolution that does not end with TikTok ban, probably a series of compliance steps. But I think we are several months away from that. I think this runs through the legal system, and you know that it probably takes a while before we actually see what happens beyond the ban that could be upheld today or this week.
I know that you focus more on the tech, Rohit, but I'm curious about the impact of the e-commerce side of this. With TikTok Shop's success over the Black Friday holiday, could something like Amazon be a beneficiary as well?
Yeah, absolutely. I think, again, it would be a small beneficiary. It could be a second order beneficiary. But when it comes to the style of younger people looking to purchase things and have a more of a serendipitous way of purchasing items, they are looking at newer places like TikTok, where the likelihood of them having an Amazon Prime membership or having a Costco membership, like I have, that's kind of the first things that we did when we got married. But those guys are not looking to doing that. So Amazon knows this. They're trying to put assets in front of younger people that could be attractive, that could replace the Temu, Shein, and TikToks of the world. So again, slightly to a smaller degree, but yes, absolutely. Amazon could start to get more eyeballs from the younger population as and if a company like TikTok starts to get thrown to the backyard.
All right, Rohit Kulkarni, thanks so much for joining us.
Thank you so much.
Coming up, we'll take a look at some of the top trending tickers on Yahoo Finance. More when Morning Brief comes back. We're taking a look at some trending tickers this morning. First up, Ulta beating on the top and bottom line in the third quarter and raising the lower end of its full year sales outlook. The retailer also reporting stronger than expected comp sales in the third quarter. The results surpassing expectations on a number of metrics as the beauty brand faces increasing competition. Barclays, Jefferies, and Raymond James are among the firms raising their price targets on the stock this morning. You can see those shares still moving to the upside, up about 12%.
Plus, Rubrik rating third quarter estimates, raising its full year revenue guidance. Analysts saying that increasing demand for data security driving those positive results. Wall Street is bullish on the stock. You've got 18 buys, just 1 hold, and 0 sell ratings. A number of firms seeing further upside for the stock, lifting their price targets this morning.
And finally, DocuSign beating expectations in the third quarter, boosting its revenue forecast for the full year as well. The company's billings growing 9% in the third quarter from the year prior. Analysts foresee further upside for billings, driven in part by early contract renewals. Wall Street is still mixed on the stock. It's got about 4 buys, 14 holds, and 3 sells of the shares, still moving up over 20% this morning.
Well, that does it for the morning brief. But keep it right here on Yahoo Finance. You got another hour of the two of us. Stick around for Catalyst. That's coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, investors cheering the U.S. payrolls report, with all eyes now turning to next week's inflation print. We'll discuss how the data could impact the Fed's path forward.
Plus, the federal ruling on the legality of the government's TikTok ban looms. We will break down what exactly is at stake.
And we'll hone in on the state of corporate America, with HPE and Lululemon jumping after earnings. All that and more coming up right here on Catalysts. Markets now pricing in an 88% chance of a 25 basis point rate cut following that November jobs report. That's up from about 70% before the report, according to our CME Fed Watch tool. We still got one more data print before the Fed's next meeting, and that's inflation coming up next week. Here with more on her outlook for the Fed's path forward, we've got Diane Swank. She's the chief economist at KPMG. Diane, great to speak with you. What would that headline inflation number have to be to change the likelihood of that 25 basis point cut on December 18th?
Well, basically, the biggest thing the Fed is watching right now is the stickiness in service sector inflation. So what we saw was an acceleration in that last month. We'd have to see a deceleration in that number to guarantee we get to the cut in December. And I think that's why we're going into this meeting and the blackout period with so much uncertainty, even though markets are very much excited about the prospect for another cut in December. The Fed itself has signaled all options are on the table of cutting or skipping a meeting in December, and that's because of the inflation data and the stickiness we've seen in the service sector. In the employment report as well, even though the unemployment rate ticked up a bit, the service sector is where gains were the greatest, and wages showed signs of accelerating actually in the service sector. The Beige Book showed that we saw earlier in the week from the Federal Reserve that entry-level wages are beginning to pick up, along with wages for skilled tradespeople. And I think those are things that are all going to factor into whether or not the Fed cuts in December. And it really leaves in our mind, it's still more of a flip of the coin.
So Diane, talking about the flip of a coin, I guess just looking ahead to 2025, there still is so much uncertainty out there. But given what we know now, what do you think would make the most sense just in terms of the pace of those cuts?
Well, already the Fed has signaled a slowdown in the cadence of rate cuts going forward, and that's because they don't know exactly what the non-inflationary rate is, and there is a lot of uncertainty about what the policy outlook will be. The Fed will not front-run policy changes, but once we do see things like tariffs and curbs on immigration, if they come to fruition even in a small portion of what the president-elect has promised, those could buoy inflation in 2025, and by our own estimates, slow down the number of rate cuts to 3 from 1.5% pre-election. And so that would be something that would not be welcome news by the president-elect, but it is going to be a sticking point if, in fact, we see things like tariffs that he's been talking about, even in a smaller portion, along with those curbs on immigration and the full extension to tax cuts.
When you are modeling what's going to happen in 2025, how is the question mark about fiscal policy impacting that model? And what are you doing to kind of find clarity? Because we don't know yet what is actually going to happen in terms of policy in Washington. It's just conjecture at this point.
Exactly. And so, first of all, we're starting out with a continuing resolution. We have to lift the debt ceiling again after January 2nd or suspend it so that we can move forward and not risk defaulting on our debt. But that continuing resolution, that means last year's budget has not been yet decided. They're going to try to get the extension of the full tax cuts into that resolution. Technically, you need offsets of increased revenues, and tariffs levied by executive order cannot count as offsets in reconciliation. You know, we've not seen either party really be disciplined on fiscal discipline, and so we don't expect that. But by the end of the year, you're going to see a new fiscal budget, and what there will be is attempts to cut spending at the same time that they raise spending on things like border security. the cuts to spending the math gets very difficult, and there certainly are efforts by the president-elect's team to think about ways to cut spending in the federal spending bill. Those get very difficult, but we do see constrained spending as we move into 2020, the end of 2025 and early 26. Remember, all of the spending that got deferred due to the continuing resolution, no matter what they decide on the budget, that will be spent in the remaining quarters of the fiscal year, which ends on October 1st.
Diane, I want to zero in on the consumer and some of the conflicting readings that we have been getting out. This morning, we just a few moments ago, we got the Michigan sentiment number actually rising to 74. This is a prelim reading. It's the highest reading that we've seen since April. Looking ahead and given some of the policy uncertainty that you were just talking about, the options that are on the table, I'm curious just to get your assessment of the consumer and what you think the consumer spending patterns are going to look like.
Well, right now we've got a lot of momentum and a tailwind for the U.S. consumer because we've seen wages outpace inflation for 20 consecutive months. That's restoring some of the purchasing power lost to inflation earlier in the pandemic, and it's clearly giving consumers a bit of a lift. We also saw the Conference Board numbers for the consumer confidence numbers in November rise quite dramatically, especially among those below 35 years of age, on better job prospects. So all of that is giving us a tailwind entering the year with the consumer, along with the surge in wealth we've seen, and older consumers are tapping that wealth via their home equity lines of credit and upgrading their homes, much to the chagrin of millennials, to age in place. So all of those things set us up for the consumer to be in pretty strong shape as we enter 2025. What will matter thereafter is how much we see in terms of rate cuts and whether or not the improvement in inflation can actually continue. What the worry is that the premium that consumers earn over inflation could narrow again as tariffs are implemented.
I want to get your take on just how certain we are that there are not cracks in this labor market, because the median duration of unemployment continues to tick up here. We're also seeing underemployment continuing to tick up from its 2022 lows. Are there cracks in this market that we're ignoring?
The thing we worry most about is there's major downward revisions that we know are already in the pipeline for 2023 and 2024, which means we have less of a cushion in terms of labor market strength. We have a lot of productivity growth, but less of a cushion in terms of job generation. And also, overall job generation is very concentrated. 70% of jobs that we've seen added since June of 2023 have been concentrated in three sectors: healthcare and social assistance, leisure and hospitality, and the public sector, mostly state and local jobs. State and local governments are expected to see some of the biggest cuts in funding from the federal government, along with the fact that their fiscal 2024 was not very great. So that could undermine the gains in employment as we move into next year, and that's something that we're going to be watching extremely closely, given how concentrated job gains remain and the fact that we could have less of a cushion. That's where there could be cracks in the labor market going forward.
All right, Diane Swonk, always great to have you. Thanks so much for taking the time. Stocks rising after a November jobs report came in higher than expected. Markets now pricing in a nearly 90% chance of a 25 basis point rate cut come the Fed's next meeting in just about 2 weeks. So how should investors be positioned with the Fed in mind? We want to bring in Eddie Gabor. He's the CEO of Key Advisors Wealth Management. Eddie, it's great to have you back on the program. So we certainly are seeing some movement to the upside here, risk on sentiment. It seems like in equities in the bond market, we are seeing a bit of a pullback, much of that based on the expectation here for that December rate cut. I'm curious just to first focus in on that bond to market reaction, a bit of a pullback. Have we seen maybe a cap in yields to the upside?
Temporarily we have, because of, I think the Fed is absolutely going to cut in December, because I think they're going to put more emphasis on the labor market than they will the inflation data that we get. But I do think it's a head fake, because I believe next year we will see a reacceleration of inflation and calls that 10-year bond to get closer to 5%. So we're keeping a close eye on the 10-year. I think that is much more important to focus on than what the Fed actually does, because last time the Fed started cutting rates, the 10-year just went straight up. So as long as the bond market stays cool where we are right now and range bound, it's going to continue to be very bullish for the equity markets. I think any dips we get in the next 2 weeks, because we are overbought short term, I think we'll get bought because a lot of cash was on the sidelines pre-election because of concerns. And now you're going to have people having to play catch up because they either were in cash or in the wrong sectors.
So how do you hedge if you're worried about the momentum stalling?
So one way you can hedge is own some gold. You know, gold, we have a little bit of gold in our portfolios right now as a hedge. We are very bullish here short term. And then, of course, always having dry powder, in my opinion, in this type of market is critical, because you'll hear people say, buy the dip, buy the dip. But if you have not positioned yourself to have cash or some type of hedge to be able to rotate and buy that dip, you put yourself in a very vulnerable position, because as we know, there's plenty of dark clouds forming right now. And as this market gets hotter and hotter going in the next year, I think it'll be time to start playing a little bit more cautious as more and more people get too bullish.
Eddie, what is the upside for gold? I mean, here we are not too far from the record highs. Does it have much more room to run to the upside?
In regards to the markets, the last, I would say we're in the 8th inning, maybe 9th inning of this bull run. And the last inning to 2 innings usually gets that blow off top. You could see markets go up, in my opinion, another 10% from these current levels between now and the first quarter of next year. And that means some individual names could go up much higher than that. So those last inning and a half is when the bubbles really explode and get to those peak levels, much higher than many people think. These valuations can get much more extended from where we are now. We anticipate that to happen. But again, that dark cloud that we're most concerned with is that reacceleration of inflation that I don't think is properly priced into the market. So we have told clients that we plan right now, we believe we will have to pivot and sell a lot of the things that we have right now sometime in the first half of 2025.
Eddie, what would you recommend investors then should sell?
So if you're going to sell right now, what we're doing is we're actually buying cyclicals. We've increased small caps. We increased our exposure to Meta, NVIDIA. So we are very bullish and tactically put that way in growth names, because I think that's what you're going to get. Now, when we start to see a top, or what we believe is a top, we are going to sell the most aggressive holdings and the most highly owned holdings. We love NVIDIA as a company and as a stock, but that'll be one of the first things we cut, because that will take a very big hit, in our opinion, if what we see coming down the road happens, as well as small caps, and you'll want to rotate into more defensive names. Right now, we're playing offense with little cash, but when we rotate, we will rotate completely out and probably own the opposite of what we own, because we'll be going from a risk-on environment to a risk-off environment.
Eddie, you sent over 5 names that'll outperform following the Fed's December meeting. You just mentioned NVIDIA and Meta. You also like consumer discretionary, small caps, and the QQQ. I want to focus on consumer discretionary because retail has certainly been mixed this earnings cycle. Why are you bullish?
We're bullish. It really came in as a contrarian play, and I think one thing you've seen is it has really caught a lot of strength. Yesterday was another great day for it, where it was up over 1% while the broader market struggled. And I think it's a component of the consumer is being resilient. I think you're going to see consumer spending stay strong throughout this holiday season and going into January. And the other thing is really just a rotation of flows of funds. A lot of folks were positioned defensively, owning consumer staples and healthcare and cash, and those areas have not done well. 8 out of 11 sectors have been down 3 out of the last 4 trading days. So again, I think it's also a function of people are going to have to rotate, in my opinion, if they want strong performance, into the areas that are weak, like defensive sectors, and rotating in. So it's going to catch a natural bid just from the flow of funds from people that are underinvested in these areas that many people, I would say, hated coming into the election.
And you like the QQQ regardless of the valuations in large cap tech?
Yes, and the reason behind that is I don't think you can have this bull market continue without mega cap tech leading the way. And that'll be, again, an area that we go to sell first. So we expect a little pullback here over the next 2 weeks. Maybe you get a 3-4% pullback, but I think they'll get aggressively bought because of how underinvested people are. But this rally is not going to continue if the QQQ doesn't continue to go, in my opinion.
All right, Eddie Gabor, thanks so much. Keep
Thank
it
you
right
for
here
having me.
on Yahoo Finance. We got much more of your market action ahead. Stay tuned. We'll be right back.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Time now for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's done with Yahoo Finance's trending tickers page. First up, let's take a look at shares of HPE moving to the upside, a huge move to the upside after reporting strong sales growth that was boosted by demand for servers to power AI computing. You're looking at gains of just about 10% in early action. So clearly some excitement, Maddie, playing out on the street. I was going through a couple of analyst reports here this morning. One of the notes that stuck out to me was Citi. They actually upgraded the stock, citing that AI momentum that certainly is carrying the trade here this morning, talking about the fact that they expect the company to benefit from improving demand here in the mainstream server, enterprise networking, but then also expanding enterprise AI opportunities, narrowing that valuation gap versus peers. That has been one of the question marks, I think, over the last several quarters about the ability to do so, what exactly the timeline looks like. So Citi very much looking at this print as the fact that they are making progress, significant progress, and they see HPE really building on that momentum.
It's a really interesting point, especially given the pressure on their gross margins, which were still huge, right? 30.9%, but that was below the quarter and the estimate for 31.1%. And part of what's putting pressure on those margins is the expensive NVIDIA chips that they're having to buy to power those AI servers. I think that's going to be really interesting in the context of what we've heard all week from Amazon Web Services announcing their latest GPUs that will be competitive with NVIDIA, despite NVIDIA being one of Amazon's biggest partners in the space. Will a more affordable outlook for chips moving forward be a boon to some of these companies like HPE, which will be able to spend less money on those expensive chips? We'll have to see how those margins look moving forward here. But next up, I want to take a look over at Lululemon. Shares are higher as analysts from Citi and Truist boosting their price targets on the stock on the back of a better than expected third quarter earnings print boosted by international sales. You can see those shares up 16%. 39% rise in China sales. Just a huge beat there, especially given the challenges that we know the Chinese consumer has been facing. Several retailers in the space have still been struggling in the region, so this makes Lulu a bit of an outlier in terms of their individual performance there. A huge sign to come of that increased revenue moving forward here. The CEO saying momentum is remaining strong in those international markets, and that is part of what led to the company rising up their guidance for earnings for the year to as much as $14.16 a share. That is a move higher from their prior guidance here.
Yeah, Maddie, when you take a look at these numbers, I think the big question for Lululemon over the last several quarters was innovation, product innovation, given the maturity of the leggings line that we have seen kind of more of a stagnant sort of sales pattern here over the last several quarters. But this outlook here kind of putting maybe some of those fears to rest. You had Piper Sandler, the analyst there, talking in a note this morning saying that they're actually showing impressive agility here to guardrail profitability, talking about the strength here in its actual mature leggings business. And that was the first time she has seen this in a while. So showing that maybe they have seen a little bit of improvement there. The international business, like you said, a very strong point there for the company going forward. So I think overall the street is viewing this as a solid quarter here for the company. It did deliver maybe a bit of relief here just in terms of the deceleration of growth that we had seen, that trend that we had seen over the last couple quarters. But I do think when you take a step back and you take a look at maybe the more macro picture, yes, it looks like the fundamentals of Lululemon are improving. That's why you're seeing the stock up just about 16%. But we talk time and time again about the consumer still spending, but the consumer's clearly pressured. And when you take a look at some of the higher priced items, and I think you can categorize Lululemon as that, with leggings going for $100 to $120, and the cheaper options that are out there on the market, I think to some extent that does remain a concern there to many on the street.
And it's a great example of the continued bifurcation in the economy between the lower and higher income consumer as well.
Well, market dominations, Julie Hyman, she will be speaking with the CEO of Lululemon, Calvin McDonald. That's airing today at 11 a.m. Eastern Time.
Coming up, we're going to have all of your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Catalysts.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Some breaking news now crossing the wire. The TikTok ban was upheld by an appeals court here in the United States. TikTok's Chinese parent company facing a ban in the U.S. if it does not meet a January 19th deadline to sell the video sharing app. This is part of a federal appeals court ruling coming through here on Friday. The company likely to issue another appeal here. They do have until January to divest or get banned from the United States. Incoming President Trump has waffled on this issue. He did support a TikTok ban due to national security challenges, but one of his biggest donors, Jeff Yass, is a TikTok investor. Following a meeting that the two had in Mar-a-Lago, we did see Trump changing his mind on a TikTok ban, though it's currently unclear what he'll be able to do to kind of change the political appetite for this ban moving forward, because this has had significant bipartisan support in Congress. And of course, we do have this news crossing the wire now, TikTok facing that ban in the United States. The appeals court refusing to block that law. Sean.
Yeah, and I think the incoming Trump administration, like you were just saying, Maddie, is a real question mark in the room right now, because this ban will go in effect the day before Trump assumes office. But then, of course, his opposition to this ban kind of puts many of these questions back on the table, just exactly how this opposition, could potentially complicate this measure and the enforcement that we could see going forward. We know, like you were just saying, he did flip after one of the top donors there, an investor in TikTok, also was trying to court some of those younger voters. We know younger voters, the younger population, obviously spending more and more of their time on TikTok, a very popular social media app there for their outlets. So again, that was a critical issue, or one of the issues, I should say, that was discussed on the campaign trail by President-elect Trump here over the last several months. And again, when you take into account that TikTok now facing this ban, and we were talking to Rohit Kulkarni last hour, an analyst in the social media space, just about ultimately what this means here for some of the other companies within the space. He very much told us that Meta is well positioned because of this. Snap will likely see a move to the upside. I'm trying to pull up what the reactions are in their stocks right now. But again, we could potentially see some movement to the upside in that trade. You have Snap actually spiking on this news off the highs of the morning, but still up just about 2.5%. So again, just showing some of that playing out here on the street. You have some of the other names up on your screen right now. Meta's also up just about 2.5%, right around the highs of the session here. So again, although there remains questions about how this is going to be implemented, just in terms of what exactly that is going to look like under the incoming Trump administration and the likely enforcement there, we are seeing some of these social media stocks here move on the heels of this.
We're also seeing Amazon up today, and you were smart to bring this up, Shauna, the idea that TikTok Shop, they tripled their Black Friday sales this season compared to previous years. Amazon, the large tech company, is already moving up off the back of that jobs print, but we're still seeing significant moves to the upside here, as Amazon could be an e-commerce beneficiary as well if TikTok were to be banned in the United States, that e-commerce flow going into a company like Amazon. Joining us more for the broader impact here on tech more broadly, we've got Yahoo Finance's Dan Howley standing by. Dan, what stands out to you about this news?
Yeah, Maddie, I think the main thing to take into account is this isn't the end of this conversation by a long shot. This is likely going to go to the Supreme Court, where it'll be meted out in some way, whether it's a full ban or not. I think TikTok will continue to try to argue the First Amendment side of things. But as far as the broader tech industry, I mean, you were talking about the numbers for the companies Meta, Snap, Amazon. This kind of just benefits them so much. Meta has been fighting to make Instagram more relevant with younger users who are on TikTok. And they've done a very good job of that with their Reels. They regularly talk about Reels during their earnings calls. They regularly talk about how AI is enhancing that. That's the meat and potatoes of TikTok, right? It's the algorithm that keeps feeding you those short form videos. And so Meta's done essentially what it did to Snap and others by kind of copying that whole format and done it very well. And so they've seen improvements there. Without TikTok, you can only imagine that creators are either going to go to Meta and work on Instagram and Reels and bring their followings along with them, or they would move to something like YouTube and work with YouTube Shorts, something along those lines. So this would be a huge boon for Meta itself. Then there's obviously Snap, a app that's more popular with younger users, though. I mean, it doesn't really make the waves that it did when it originally came out. That could also see a jump just because of the kids looking for a place to go that, you know, their uncles or whatever aren't hanging out on. And then, you know, there's the idea of the e-commerce side, as you talked about with Amazon. You know, there's TikTok influencers, there's Instagram influencers. They both sell. And then Amazon, obviously, wanting to hold on to as much of e-commerce as they want, they're going to potentially try to jump in here now and be a place where some of those influencers are. And so, you know, I think it's also worth pointing out, as I said, you have the Instagram influencers with sales as well. I'm 39. A bunch of people in my cohort I talk to regularly say that they buy things from Instagram ads, and so you can imagine that could pick up if TikTok isn't there with the younger generations. I think it does open up for maybe potentially a new entrant in the field. But I think as far as the established players, it really is Meta that's going to benefit the most here. But as I said, this is not the end of this conversation by a long shot.
It's not the end of the conversation, but over at Bloomberg Intelligence, Matthew Shettleman's seen a 70% chance that TikTok loses the D.C. Circuit ruling moving forward here, with the likelihood that the company is going to make a last-ditch plea to the Supreme Court to pause that January 19th deadline. Dan, thanks so much for joining us here. We appreciate it. We're going to talk about the market reaction to this news. Again, TikTok facing that ban in the United States here after appeals court refusing to block a law on this. And it's really interesting because the Magnificent Seven stocks, they've already been up about 65% year to date. We've seen a 4% rally, I believe, over the last couple of days, already hitting a fresh record yesterday. And then you've got this news on top of it, adding to a bit of that rally. The likes of NVIDIA actually down right now, but every other name in the Mag 7 moving to the upside, especially those that are beneficiaries of this potential ban.
Yeah, we talked to so many strategists even this morning talking about how critical it is for tech to retain and maintain its momentum here going forward into 2025 if we want to continue to see this risk on sentiment that we certainly have seen in the market, to say the least, over the last several months and several years. So again, when you see a ruling like this, obviously lots of questions just about what exactly this is going to mean here. The fact that TikTok now facing that U.S. ban after the appeals court did refuse to block the law, questions about whether or not it's going to be, or I guess how strictly it will be enforced is a better way to put that here, under the incoming Trump administration. But again, when you see some of that excitement playing out on the street here this morning across some of those mega cap tech names, given the size of it, given their influence that they do have on the market, given the massive run that we have seen over the last couple of years, it does point just in terms of that, or adds to the overall bullish sentiment that we have been hearing from strategists entering the new year. And I think kind of ups the chances, or ups the confidence, I should say, just that we could see more highs or more of that movement to the upside here in the coming months.
And it's really interesting given that you still have investors, the likes of Mitchell Green, for example, investing in ByteDance because of the amount of global traction. The company still has a smaller amount of users stateside, so we will still continue to see that global use ticking up. And of course, we will monitor this news as we learn more heading into that January 19th deadline. Coming up, the outlook for corporate bonds in 2025, why our next guest says investing in corporate bonds will still make sense. That's coming up next right here on Catalysts.
Some of the biggest names in the industrial sector getting together at Goldman Sachs' Industrial and Materials Conference this week. I had the opportunity to attend the conference. I had a chance to speak with so many executives and lead industry analysts yesterday about what President-elect Donald Trump's policy agenda means for business. Very much the focus was not so much on the end of the year and what we have seen, but really how this is all going to play out in 2025. One of the conversations I had was with the co-president of HEICO, Eric Mendelson, and here's what he had to tell me.
I thought the Trump administration would be very positive for aerospace and defense. And the vast majority in private conversations, the vast majority of the CEOs and the executives with whom I speak feel 100% the same way. Sometimes they're a little bit concerned to speak out about it, but we think that it's going to be, it will continue to be very bullish. If you look at in the first Trump administration was very good for aerospace and defense. Just in general, an increase in confidence in the economy. People feel better, they have more money to spend, airlines expand, they buy aircraft, they fly the aircraft more, people travel more. We just think it's in general a very positive environment.
So, Maddie, when it comes to some of those expected policies here under the incoming Trump administration, you talk about tax cuts, you talk about scaling back regulation, really promoting domestic industries, which I think is something that really played to so many of the executives that I had a chance to speak with yesterday. And just sticking with HEICO, this is a stock that has outperformed. Taking a look at that year-to-date chart, shares have had this steady climb to the upside here, and you're looking at gains of just about 50%. So you can certainly see that excitement. It's held on since we got the results of the November election. I also had the chance to speak with the chair of Planet Labs Federal, and he was just talking to me, and this conversation was more so zeroing in on Musk's role in the administration, what ultimately that means for some of these space stocks here. When you take a look at Planet Labs, even just the last month, all the way out to the right hand of your screen, since Election Day, Maddie, this stock has actually risen about 80%. So I think that just really speaks to some of that excitement there. He was able to tell me that he did think that obviously Musk being or having an influential voice in the incoming administration is very, very positive here for the sector at large. And I think that very much echoes some of the sentiment that we have heard across the board from various industries just about what these incoming new policies are going to be, particularly on the scaling back of regulation has certainly been a common theme.
I think it's been really interesting to hear the optimism about the incoming administration's policies, given that we don't actually have any of those policies in place yet, but the market is pre-pricing in a lot of the impact. I love how you asked that follow-up about, well, why is that? Why will we continue to see more room to run for some of these sectors and names? And it's just this belief that because of the economic team surrounding Trump, including the likes of Elon Musk, that a lot of those policies are going to come to fruition.
Yeah, and what's so interesting is that there is so much optimism, right? But on the flip side, there is some hesitation. And I brought that up. And two of the themes that kept coming up in my conversations yesterday, one was about tariffs, two was about cuts in spending, what ultimately that means for the defense companies. But I want to zero in on tariffs because that is such an important issue as you look ahead to 2025 and exactly when that fallout it could potentially occur in 2026. And here's what Mendelson told me about how HEICO is thinking about the potential threat of more tariffs.
We do have our eye on it. We've always been very fair with our customers with regard to price increases, so we do intend on passing that along to our customers should that impact this market. I think there's some talk about aerospace and defense maybe being slightly exempt from some of that, but we're going to have to see where that ends up.
So the sector might not be the hardest hit when you compare it against some of the others that have a little bit more exposure, but clearly it is a concern, and it's something that many management from many companies are thinking about as they try to adjust their playbook for the next several years and how exactly they are sourcing some of their material, where they have their manufacturing plants. And Maddie, Stanley Black & Decker, their CFO, also making some comments just about diversifying their supply chain away from China. It's a strategy that they have implemented and really have worked on over the last several years. But he actually made the comment that this administration might actually accelerate, maybe to no surprise, accelerate the pace of reducing exposure to China. And as it stands right now, they get about a quarter of what the company sells is from China. That might sound like a lot, but that was down from about 40% a decade ago. So they have been trying to lessen their exposure there. It is a concern for the stock. You are looking at a year-to-date chart of the fact that the stock is off just about 13%. So clearly underperforming the sector at large, underperforming the broader market at large. So tariffs is a real risk to this sector. And we're seeing some of these executives, some of these companies adjust right now in preparation for that.
And as always, Shawnee, you brought us amazing reporting from your on-the-ground experience with Goldman. So thank you for bringing us those conversations. Always appreciated, of course. We're going to move on to President-elect Donald Trump's policies that could have a big impact on corporate America next year. Joining us now, we've got Colin Martin, Schwab Center for Financial Research fixed income strategist. Schwab is out with a corporate bond outlook for 2025. Explain to our audience why they should even consider looking at corporate bonds when you've got the Magnificent Seven still up near 70% year to date and expected to rally heading into the next year.
Well, that's a great point, but we try to separate the two because when you talk about the Magnificent Seven and how they relate to the stock market, it's important to separate them and treat them as two different asset classes. So the outlook for stocks might be relatively favorable, but that translates to corporate bonds. And they both play different roles in portfolios. And we think about bonds, any type of bonds really, but specifically with corporates today, we think the yields are really attractive. So you alluded to the idea that we do have this positive outlook. I think it's important to focus on income and focus on yield, where you get some volatility here and there, but from a big picture standpoint, if you look at investment grade corporate bonds, so those rated BBB or above, you can get average yields of around 5% or more, depending on what maturity you're looking at or depending on what the specific credit rating is. I think it's really important to focus on that, because if we go back relative to the past 15 years or so, we're still at attractive levels, especially where we were leading up to the pandemic. So we know that income plays a huge role for investors as they're approaching retirement or they're in retirement. And given what we think is a relatively positive economic outlook, we're okay taking a little risk with corporate bonds, and we think they're a nice way to boost some income in your overall portfolios.
Yeah, Colin, talk to me a little bit more about that and how that's playing into the outlook here for 2025.
Well, one thing we're looking at in terms of the relative strength we're seeing and the idea that we're probably in a soft landing for now. I always think that's an interesting topic because I feel like we've been in a soft landing. Whether that remains the case in 6 months or 12 months is anybody's guess. But right now, we're still seeing positive growth. We're seeing inflation that's trending lower, albeit in a bumpy fashion. And I think a lot of that does come from corporate America. If you look at corporate fundamentals, which is something we focus on a lot, they're relatively strong. We're seeing corporate profits at or near record levels. Now, we're not looking specifically at the S&P 500 or even those that are in the bond indexes, but in aggregate, and we get data from the Bureau of Economic Analysis, corporate profits are well above the pre-pandemic levels and have been hovering at record highs for the past few quarters. And corporate balance sheets are really, really strong. They're earning more income from the assets that they have on their balance sheets because interest rates are up so much, but there's plenty of cash. There's plenty of liquid assets. So even if we were to get some sort of stumble, and there's a lot of uncertainty out there, and let's say we see maybe some economic, a minor slowdown, we think most corporations are really well positioned to handle that because there's a lot of those liquid assets on their balance sheets. Now, that's a risk probably for the lower rated parts of the market. You know, they have more debt, they have more volatile cash flows. But if we're talking, high quality, highly rated corporate issuers, we think they're just in really good shape to really withstand whatever comes their way over the next 12 months.
And those corporate bonds, like you say, have been outperforming U.S. Treasuries year to date. We've got a chart from your latest note just about how riskier fixed income investments have been outperforming this year. You can see preferred securities and high yield corporates, to your point, near the top performers at that chart. Do you expect a similar dynamic heading into 2025 where investors could be getting a little bit more from these higher yield corporate bonds versus the premium, safety vehicle of U.S. Treasuries?
We think outperformance can continue, but we don't expect that same level or magnitude of outperformance that we've seen so far this year. If we look at the level of spreads, that's something that we focus on a lot. That's the relative yields you earn by investing in a corporate bond above a comparable treasury. Spreads are really, really low right now. They're razor thin and near their historical tights. And that's been a key driver of that outperformance so far this year, because as spreads fall, as investors and lenders are comfortable taking lower yields to lend to those corporations because of such an optimistic outlook, that helps boost their prices. But with spreads where they are now, it's going to be really difficult to get more spread compression, which would boost those prices relative to treasuries. So outperformance is possible, but I don't think we're going to get that same level of outperformance that we saw this year. And where we're at right now, the low spreads and outperformance in 2024, it's sort of a double-edged sword. On the bright side, low spreads in and of themselves are indicative of a healthy economy. It shows that investors and lenders are willing to accept lower yields given such a positive outlook. But it makes it a little bit tricky for investors because we think it makes sense to take additional risks if you're being paid well for those risks. And that's really not the case with a lot of lower rated corporate bonds today.
All right, Colin, we have to leave it there. Thanks so much.
Thanks for having me.
Coming up, we are taking a look at how the incoming Trump administration could impact commercial EV market with InCharge Energy's CEO. He'll join us when we come back.
President Trump has pledged to end the electric vehicle tax credit for individuals when he gets into office. On the commercial side, InCharge Energy partners with major players, including BYD, Ford, GM, Honda, and FedEx, also UPS, to electrify and charge truck fleets. For a look at how the administration's policies and funding could impact the commercial market, we're going to bring in Terry O'Day, InCharge Energy's COO. Terry, great to speak with you. I want to start on those partnerships, the likes of BYD, for example, huge names in the EV space. Are they still committed to electrification and working with you all moving forward, even if and when those policies from the Trump administration come into play?
Yeah, definitely. For a lot of these companies, particularly the manufacturers, this is a story about global competitiveness for them. The Asian market, the European market, they're both well ahead of us in electrifying, and they have products and investments that are still coming to fruition. In the US, we need to keep our automakers competitive. We need to continue to focus on the investments that are going to put them into technologies that allow them to compete globally. So they're telling us, yes, they intend to continue most of those investments.
Have you seen no shift then in the strategy from corporations just in terms of trying to electrify their fleets?
They are slowing down for sure. On the fleet side, we have seen over the past year, this has been happening all year as there was an election uncertainty. A lot of the investments are slowing down, they're shifting. We saw automakers that had major dealer programs kind of rolled back some of those dealer programs, letting the dealers figure that out themselves, working with infrastructure providers that are more regional or other solutions like that.
I'm interested in the conversation with you because it's also an indicator of how this industry is preparing for tariffs. The market seemed to understand, and businesses seem to understand the incoming tariffs on China, but Canada and Mexico and the degree of tariffs Trump has teased out for those areas of the world were a little bit more surprising. Talk to me about what you're hearing from partners about how they're preparing for those potential tariffs.
That was a big surprise. A number of companies have shifted to European suppliers, but now that we saw this announcement related to Mexico and Canada, it's not clear what kind of tariffs we're going to see on Europe also. So I'm seeing a lot of uncertainty around the supply chain. And while there has been a significant investment over the last 4 years to build an American-based supply chain, it takes time to do that. So the Biden administration policies and the investments from the Inflation Reduction Act and others enabled us to start to invest in some of the components and manufacturing here in the U.S. They have requirements for any of the federal funding that was to be received for fleets and for public charging, that they be built, that the equipment be built in the U.S. So a lot of the supply chain started to come here, but it's not all the way there yet. And there's a lot of uncertainty now in the market.
Terry, we only have about 45 seconds here, but given the fact that we are expecting a rollback here in EV credits, I'm curious what that's going to do to the cost of all this and how big of a challenge that's going to be.
Well, right now we are cost competitive with diesel and gasoline. The challenge is how fast will this industry move? How quickly will fleets and consumers notice that we have better products and lower costs? That's ultimately the question. How fast will the industry grow? We know that costs are going to go up overall, so it's still to be sorted out how much.
All right, Terry O'Day, COO of In Charge Energy. Thanks so much.
Thanks to you.
That does it for us for the week. But coming up next, we've got Wealth that's dedicated to all of your personal finance needs. Ali Canal has you for the next hour. We'll see you on Monday. Have a great weekend.
Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, we'll dig into the November jobs report, what it means for the economy and your investments. We'll also talk to a business leader who scaled his company to $100 million in revenue in just 6 years. And we'll discuss the outlook for the housing market in 2025. Will we see mortgage rates fall below 6% next year? We'll discuss that with an expert. Plus, Lululemon lifting its full-year outlook as it sees strength across international markets. Don't miss our conversation with Calvin McDonald, the CEO of Lululemon, in just a few short minutes. Now time for some of today's trending tickers. Scan the QR below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We're looking at some of the top analyst calls of the day. First up, Abercrombie & Fitch initiated as outperform with a $180 price target at Raymond James. The analyst citing the retailer's revamped business, saying growth should remain robust in 2025. And Hollister, which accounts for half of Abercrombie's revenue, is now leveraging the strategies that have made Abercrombie so successful. Next, Dollar General upgraded to buy from underperform at Bank of America. The analyst citing early evidence that the company's back-to-basics strategy is working. This includes better inventory management, stock levels, customer satisfaction, and successful merchandising initiatives. And Peloton getting an upgraded to neutral from sell at UBS with a $10 price target. That leaves the stock with just one sell rating on Wall Street. The analyst writing that although Peloton's growth outlook remains quite elusive, the company should be able to improve profitability with further cost cuts on top of the $200 million already announced. And let's take a look at some of the market action 90 minutes into the trading day. Stocks moving higher following the better than expected November jobs report. Joining me now is Adam Coons, Winthrop Capital Chief Investment Officer. And Adam, let's start there. The latest jobs data we got this morning. We saw growth rebound in the month of October, but a slight uptick in the unemployment rate. Does this keep the Fed on track to cut interest rates later this month? And perhaps even more importantly, how do you think this will change the Fed's projections, since we will be getting that fresh dot plot at the policy meeting as well?
Sure. First off, thanks for having me. First off, this does continue to prove that, the labor market is still relatively strong. We got to keep that in mind. We did see an uptick in unemployment. I'll come back to that because it is important. But like I said, we're seeing the addition of jobs. It was better than expected at 227,000. I do keep in the back of my mind the fact that we have continued to see, fairly large revisions to a lot of these economic releases. So and usually over the past 6 months, those revisions have been, to the downside or, worse as they come back. So I'm keeping that in the back of my mind. And then I shift my focus to the unemployment rate. We do continue to see it tick up. So it's moving in the wrong direction. 4.2, like I said, still historically is very low. But, on a rate of change basis, which is extremely important from the low, it's obviously moving, like I said, in the wrong direction. So when we hit on the Fed and what they're going to do or might do is, I think that they are still kind of moving in the direction of slightly easing policy. I think they came out of the chute with the 50 basis point cut. That was good to kind of stabilize and kind of have this normalization of monetary policy as they shifted. We got a 25 basis point cut last month. And then there's the expectation of a 25 basis point cut in December. I still think that is too soon to call that they will make that rate cut. There's not a lot more economic data to come out, but I think, we really got to see what the consumer's doing. And as we get closer to, the holiday, extravaganza of spending, Black Friday seemed okay, but it's just really, what is the consumer able to continue to spend? What does that do to inflation numbers? That obviously matters a lot to the Fed as they're trying to really get, that 2% target. So there's a lot at play here. I think right now, like I said, it's probably a 50-50 chance with what information we have today as to whether the Fed cuts again in December, and then that spills over into what they're going to do in 2025, obviously.
Right. So it seems to me that you think there could be a higher for longer policy stance from the Fed. So how should traders be adjusting their investment allocations heading into the new year and really preparing for that?
I do, and it's really driven on the fact that there's just not enough information to push the Fed to really moving into an easing cycle. Like I said, I get these short-term shifts made sense to kind of dial in monetary policy, but to just really go down a path of cutting rates, there's just not enough to support that right now. So I think the one thing you've got to look out for if you're a trader is playing a little bit more defense. It's been a tremendous year for the S&P 500 and just equity holders in general. It's been a very good year for bondholders alike. So I think kind of as we head into the end of this year and look to next year, there's nothing wrong with playing a little bit more defense. I'm not saying move to cash by any means, but I think dialing back some of those higher volatility names and moving towards more maybe dividend playing type stocks is a good idea, because if the Fed does move more slowly, we're in that regime that if the Fed doesn't cut, I think that could add volatility to the markets, because that's really what the markets want, right? They want the Fed to ease policy because that makes borrowing easier, which makes generally drives equity markets up. And so I think if we see the Fed dial back their cuts, I think that wouldn't be good, at least in the short term, for the stock market.
But one asset that is definitely risk on and getting a lot of attention recently is Bitcoin. We're seeing the crypto trade below that critical $100,000 level right now, but analysts still see a lot more room to run. So if you're not exposed to Bitcoin at this point, did you miss the boat? What should you do now? How can you really capitalize on this rally, especially since we have an incoming Trump administration, which has been viewed as generally more favorable to the asset?
Yeah, I mean, I think obviously this is a more of a narrative kind of momentum trade at the moment. So again, I think I would be really cautious if you've missed out. Don't just succumb to the FOMO trade, but it's something to watch. I think if you do want to kind of dip your toe into the water, just position size is really important here. This is a high volatility, trading security, and so the most important part of that in a portfolio management aspect is just to manage your position size. This is not, a stock that moves 2 or 3% a day at most. This is something that can, move 10% at a clip if the right circumstances. So I don't think there's anything wrong with starting to, open a position. I think you just need to really watch your position sizing and just really watch the momentum. I think, that's purely what this is right now. And momentum can work for quite a long time. So I do like to trade right now from momentum standpoint. There's some stocks that are kind of following the same trend, really kind of on the coattails, as you said, of the change to the Trump administration. So I think follow that trend for a while and just manage the position size.
Don't get caught up in the FOMO trade. Easier said than done. But Adam Coons, thank you so much. I appreciate your insights.
Thank you.
Turning now to the top trending ticker on the Yahoo Finance site, shares of Lululemon soaring today after a strong third quarter boosted by international sales. The company also lifted its full year forecast. Market Domination host Julie Hyman joins us now with the CEO. Take it away, Julie.
Thank you so much, Allie. Indeed, I'm here with Calvin McDonald, the CEO of Lululemon. Thank you so much for coming in to see us.
Oh, excited to be here.
Appreciate it. So we are indeed seeing that strong international growth, particularly in China, in the U.S. And in the Americas generally, not seeing as strong of growth. And I know you got the question on the call about whether the Americas have bottomed, whether you think there's going to be that upward inflection from here. What do you think?
Yeah, there's no doubt in my mind that we have a long runway of growth still in the Americas and in particular in U.S. When we look at our growth around the globe, as you mentioned, we're growing in every market. Double digit, 39% in mainland China, 24% in rest of world, 9% in Canada, and we're growing men's in the U.S. Our opportunity is in women's in the U.S., and as I've talked to in the data, specifically points to missed opportunity on our newness. So when you look at all data in terms of engaged guests, guest acquisition, retention, unaided brand awareness, there's a lot of growth still ahead, and the team's focused on getting back to those historical newness ratios. And in our Power of 3 times 2, 24 is our third year with our guidance. We have a 19% CAGR. We set a goal of
compound annual growth rate.
Correct.
For folks who don't
yes. know. And we set a goal of 15%, which will allow us to double the business by 26. We're ahead of that. And we said we would grow North America by double digit, and we haven't changed our view of our ability to do that.
So let's dig a little bit more into the newness, right? What does that entail, right? If I go into Lululemon as a woman shopping for Lululemon merchandise, what am I going to be struck by in the new year that is going to compel me to buy?
Yeah, we look at our merchandising mix. We build it from a very strong foundation of core and core colors. That's what allows our brand to not factor into fashionable trends, changes, seasonality risks, and hence why our markdown is a managed part of our business and our margin structure. But the core business is very much core driven in core colors. Then on top of that, we add color, print, patterns in those core. We see that as newness, seasonal newness. And then we bring newness through innovation. It could be a new hero item, franchise like soft jersey, zeroed in, that we've introduced. And then on top, it's styles that we're just introducing as surprise, unexpected, that are only intended to be in the stores through that season. Historically, when we look at those layers on top of core, it's represented a percentage of our business that this year the mix was designed to be below. And we're adjusting that and setting up, through new leadership and structure changes moving forward. But that's how we think of our mix, and that's where the opportunity is. And what we've seen is a guest who's highly engaged, coming in, and spending still. It's just the revenue per guest is below. All the newness she's reacting to, we just know is a composition of the mix. We have less than we've traditionally had, and we've seen that in the data. So all data has pointed to a brand that is still highly engaged with our guest, and a mix opportunity that we own, we're focused on, and excited to deliver in Q1 when we get back to those historical levels, and therefore feel confident in the inflection.
A couple of years ago, when you talk about the hero product, the belt bag was the thing. Then the sort of crossbody bag became the thing. What's going to be the thing for Lululemon in 2025? What's your prediction?
We have a lot of things coming that I'm quite excited about. A lot of our newness and innovation is rooted in performance across our categories, continuing to grow out our play categories of golf and tennis, as well as our own categories of run, train, and yoga. The beauty is the guest really chooses. We have a lot that I'm excited about across all of our categories, and we will see how she responds. But the percentage of is back to historical, with a lot of things that I know I'm personally excited about. I'm a big, one of the users of the wear testing of the product and give feedback to the team. And there's a lot of really exciting newness coming and innovation.
You mentioned the growth in China, which is especially notable considering how many companies are now not growing in China. We're seeing decelerating growth in China. What is it that you guys are doing there differently? I know that a lot of you have a lot of events there tied to their stores. Do you think that's kind of the special sauce, if you will?
Yeah, I think it's definitely part of our differentiated model of how we connect to the community. And I think that definitely helps to establish a very strong foundation. We've been in mainland China now for 10 years. We take a very concerted and focused growth strategy. We want to establish those roots. We want to establish stores and communities and build relationships. And I think that strong foundation allows us to continue to grow and withstand some macro challenges. Because it's rooted in really differentiated product and connection with the guest, and we're early in our growth. But we monitor the macro. Obviously, we aren't seeing an impact on our business yet, but very pleased with our growth and the potential still in the market where we are very early. Unaided brand awareness is in the mid-teens versus even US, where we're at 36%, compared to other brands in this space that are global and have more mature. They're in the 80s. So we have a long runway in all of our markets for guest acquisition.
In terms of supply chain, I know you don't really source from China. You don't really source, I know you talked about on the call, from places like Mexico. So not in the markets that are being talked about as being the most highly tariffed. But there's also, of course, this idea of a universal tariff that's being floated. Are you all considering that? Are you bringing in inventory now to sort of prepare for that? How are you thinking about it?
We're not changing our inventory position. Inventories in Q3 were up 8%. We're almost pretty much in line with sales. We're going to continue to manage our inventory with what we know today accordingly, in line with our estimated revenue growth. True, we source 3% from mainland China, and if the position on tariffs changes and is more broad, like other businesses, we'll have to adjust accordingly. Variety of factors internally, how we look at cost structure, as well as looking at pricing and other ways to sort of absorb some of that headwind that will be created. One thing I believe with our management team through many of the challenges we've faced macro through the past few years, pandemic being obviously the peak of that, is a proven record of agility, adjusting, and delivering. And we'll continue to sort of focus on what we control and how we move forward with what we're faced with.
Right. Calvin, thank you so much.
Great,
really
thank you.
Appreciate it. And Allie, back to you. Actually, more on wealth after the break.
Disney increased its annual cash dividend by 33% to $1 a share earlier this week. Dividends are the percentage of a company's earnings paid to shareholders as their portion of the profits. So for investors looking to maximize their income next year, should Disney be a stock pick, or are there other options out there? Here with some data is our very own Rochelle Akufo. Rochelle, what'd you find?
Hi, Ali. So as you mentioned there, Disney hiking its annual dividend from 75 cents to $1 in 2025. It might not sound like much, but don't sleep on it. That is per share, and it adds up quickly. In fact, Nasdaq data shows dividends alone have accounted for almost 40% of stock market returns over the last 100 years. So definitely some data to back that up. But here are 3 top picks for high dividend stocks to check out from our Yahoo Finance watch list. First, you have diversified holding company Icon Enterprises LP, that's the ticker IEP. You also have Zim Integrated Shipping Services Limited and metals and mining firm Vale SA. Now, keep in mind, these are names that most analysts see the biggest potential upside going into 2025. You'll also notice that most of these high yield dividend picks that you see on lists, they don't tend to be from the flashiest sectors, but they are what consumers consistently need and what manufacturers produce. Think utilities, materials, health, and consumer staples as well, Ali.
So Rochelle, how do you figure out which dividend paying stocks are best or perhaps the most stable to invest in?
So there are some things to put on your checklist. Now, having a high yield can either signal an undervalued stock, in the case of Disney, where most analysts have a buy rating and they see some upside there, or it could be from a share price tumbling, which is a red flag as they're trying to sort of get investors to stay on board. So you have to really check the business fundamentals when it comes for this. So check for some of these declining revenues, profits, or market share as well. You also want to look for companies with a history of increasing dividends annually. That also signals stability and growth. Now, these offer a more steady and predictable income, as we mentioned, not the sexiest of names, but they are steady for investors, and that can help outpace inflation and economic uncertainty. Especially keep in mind we have an incoming Trump administration that might shake things up in that regard. And a fun fact, I am a bit of a nerd, a dividend aristocrat or a dividend king is a company that's increased annual dividends consistently for at least 25 years. So look at the name American Waterworks. Now that holds the record with 70 consecutive dividend increases. So make sure you look out for some of those lesser known names as well, Ali.
Dividend king, Rochelle. I'm going to use that when I go out to dinner tonight and see who knows what I'm talking about. Rochelle Kubo, appreciate it. Thank you so much. Mortgage rates ticking lower as we head toward the end of the year. The 30-year fixed rate now at 6.69%, according to Freddie Mac. But could a new year bring new rates? Here with her 2025 housing outlook is Nina Gidwani. She is a Chase Home Lending head of refinance and home equity. So Nina, let's start there. On mortgage rates, will buyers finally see some relief in 2025?
Well, it's great to be here, and thanks for having me. We hope that we'll see some relief in 2025. Of course, we can't predict where rates will go. I can tell you that if rates were to fall below 6%, about 4.7 million customers would become in the money for a refinance. And of course, it would really open up the purchase market as well and help prospective home buyers get into the market. So we do hope that we'll see some additional rallying in 25.
So Nina, I know you can't predict rates, but is there any type of floor, any type of ceiling, especially when we consider factors like the Federal Reserve? There could be a higher for longer policy stance from the Fed, along with the incoming Trump administration. If there's any policy changes that we could see there, what are you looking at?
Well, we're looking at everything that is coming out right now. A lot of the economic indicators around unemployment and inflation, that even just today's jobs report. But we are not opining on any specific policies. Our key here is to remain available for customers who are looking to get into a home buying situation or they're looking to refinance. And right now, affordability is a challenge for many customers. And so we're very focused on making sure that we can help alleviate some of those challenges and also educate customers, make sure they're financially prepared to enter the home buying market if they choose to do that.
I mentioned the Trump campaign, and we know that one of his campaign promises has been mass deportations. What's the pull-through impact that could have on the housing market, especially when we think about things like the construction labor force?
I think our main focus is on making sure that home buyers can be prepared to get into the market when they're ready. We're not really focused on any specific policies, but again, our focus has been to work very closely with every single administration and to make the goal and the dream of homeownership a reality for as many customers as possible. We really just want to make sure that customers can enter the market when they're ready, and that, things like home buyer grants and assistance programs are available for customers who are looking to alleviate the cost of homeownership.
In the current market, it's often been categorized as locked in, priced out. In other words, people aren't leaving their homes because they're locked into these ultra low mortgage rates, and that's pushing up the prices of these homes, which has led to the affordability crisis. So how can that supply and demand story change? Is it more buyers coming into the market? How are you looking at the different housing dynamics?
Here's how we're thinking about it. Obviously, with the recent rallying in September and October, and the Fed cutting their rate by about 50 basis points, that created some alleviation in the refinance rates and also purchase rates, and we saw some good momentum in that period of time, and that helped to open up this sort of equation for customers looking to enter. as well as customers looking to refinance. So we would expect that, as customers continue to get more comfortable with more elevated rates, that they may be willing to get out of the lock-in effect that you mentioned, Alexandra, that if they're sitting on an ultra low rate, that they may be willing to trade that for a higher rate in order to be able to move and switch into a different home. That will then create more inventory and more opportunities for prospective home buyers to get into the market. But a lot of this will generally be very rate driven into the next year.
We'll see how things change in 2025. Nina Gidwani, thank you so much for your insights.
Thank you.
Well, from one house to another, we're talking about the moving business. Piece of Cake is a New York-based moving company founded in 2018. The company moves people across all 50 states, bringing in more than $100 million in revenue last year. The founder and CEO of Piece of Cake, Vojo Popovic, joins me now. And Vojo, what made you want to start a moving company? Because it's very labor intensive, especially in New York City. It can be very saturated, not a ton of innovation. So what gravitated you towards this line of work and really this service?
True. Thanks for having me, first of all. So I started working in the industry at a very young age, at the age of 21. And after a few years moving in different roles and working in the industry, I figured it was very outdated and it hadn't been modernized to meet today's customer. And I saw there was plenty of room for improvement. And I always wanted to run my own business, and that created kind of a perfect opportunity for me.
So how have you modernized this business?
So it sounds simple, but it's essentially simple, but it's all in execution. So we focus heavily on customers' experience throughout the whole moving journey. So we went to create a Michelin star moving experience, and so we do that by focusing on every touch point a client has with Piece of Cake. So for example, from a moment a client calls, they will be assigned a personal consultant who will be with them throughout their whole moving journey. So a client always has a live person to talk to text to email to. And another thing that we do is, and we call it internally a matchmaking between a crew and a customer, is we try and figure out where in life is that customer. Are they upgrading, downsizing? Are the students moving into their first home, or a family moving out of town? And then we would try and match and kind of pair a pace and an energy of the crew with the customer to provide the most personalized moving experience.
Yeah, it feels very personalized. And I mentioned how successful your company has been in terms of the revenue growth. $100 million in 2023. That's up from $900,000 in revenue in 2018. What do you credit for that type of rapid success? Is it the marketing? Is it your labor force? What has really driven that for you?
It's definitely a mix of all of that, everything that goes in one company. But number one resource and number one reason we credit that for is definitely our people. So we always we wanted to create a workplace and a moving company that any mover will say this is the best moving company I've ever worked for. So that was for us. It was number one, that people who represent the brand, that they feel they're part of the brand, they are the brand, and I definitely credit all of our success to our people.
Yeah, and to that point, out of your first 5 employees, 4 are in leadership roles and are in charge of departments now, which is very impressive. Now, you also have received no outside funding, just reinvestments into the business, which was surprising to me. What led you to that decision? Would you ever consider sourcing funding down the line?
So we never taken, as you said, we never taken outside funding. We never considered it. I believe in reinvesting in the company with the profits you have, and essentially I believe in keeping customers happy, keeping employees happy, and that will undoubtedly lead to growth and future customer acquisition.
And for other entrepreneurs out there, what lessons can be learned? You had a lot of barriers to entry, right? You came over here at the age of 20, you had no college degree. What would your advice be to those that are starting their own business and maybe feeling discouraged or not sure where to go next?
So the advice, I'm not the one to give advices, but what worked for me is every day you visualize where you want to be, where you want to go, and you put up that vision in front of your mind every single day. And then every decision that you make daily, you put it up that vision and see if it works for that vision or not, and that's how you make decisions. And that, and stay away from, always try to stay away from indecision, because any decision is better than indecision.
I like that. Any decision better than no decision. Vojo Popovic, thank you so much. Appreciate your time today.
Thank you for having me.
Of course. Well, if you're looking to start your own business, transition jobs, or even apply to your first ever job, we have you covered with some expert advice. Yahoo Finance spoke with a number of Wall Street leaders at our annual Invest conference last month, and they offered some great insight into what they wish they knew before they started their careers. Take a listen.
The one thing I wish I knew before I started my career is that no career is linear, and each new adventure unlocks and leads you to the next.
I wish I knew how many things that I thought were important when I was younger are actually not important. Don't get hung up on a bunch of small stuff.
If you don't really love what you do, you just can't be successful. It's only if you really enjoy what you're doing are you going to put in the time, the effort, have the curiosity, have the passion to actually do really well in it relative to all the other smart people who are also going to work really hard.
Make sure that you always are seeking more and more opinions from more and more people as you decide to do something. When you're young, you think you know the answers. As you get older, you realize not only do you not know the answers, you better have a lot of people's thoughts about an answer.
It doesn't matter what people think of you. Don't change, just stay focused, stay centered, and be authentic, and that'll serve you well.
Enjoy the ride. Every single step is going to be meaningful in your life. You don't get them back, so have fun.
We are 2 hours into the trading day, and it is time for Yahoo Finance's Market Minute. The S&P 500 and Nasdaq hitting new highs on a better-than-expected jobs report. The Dow the only one in the red. 3 trending headlines we are watching today. Shares of Palantir Technologies getting a lift on a new partnership with defense contractor Booz Allen Hamilton. The deal to drive innovation for the U.S. military expands on an existing agreement between the two companies. Shopify is popping after a Wall Street analyst upgraded its stock, citing the company's use of AI. And Uber's teaming up with Chinese robo-taxi firm WeRide to offer self-driving service in Abu Dhabi. The fully autonomous rides are set to launch next year. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
A retailer originally known for its yoga wear, Lululemon has evolved into a competitor of Nike, Adidas, and many more. But what led to Lululemon's success? Let's dive into the company's biggest moments with Beyond the Ticker. Lululemon was founded in 1998 by Chip Wilson. On July 27, 2007, Lululemon went public via an initial public offering, an IPO, on the Nasdaq at $18 per share. In March 2013, Lululemon recalled 17% of its black yoga pants for being too sheer, which cost it roughly $60 million in lost sales, according to the New York Times. That November, Wilson resigned as chairman following accusations of fat-shaming brand strategies. Wilson previously told Bloomberg TV that issues with his company's leggings were because, quote, some women's bodies don't work for the pants. In June 2020, Lululemon took a chance at at-home online fitness with the acquisition of Mirror for $500 million and rebranded it as Lululemon Studio. In 2023, the company announced plans to ditch the Mirror fitness hardware with plans to end its classes in 2024. To soften the blow for investors, it signed a 5-year strategic global partnership with Peloton, which would stream its classes on the connected fitness platform and produce and sell Peloton-branded clothes. Lululemon shares soared over 57% in 2023, with the company hitting an all-time high stock price of $511.29 on December 29th. Lululemon continues to expand and compete with the giants of the athletic apparel industry, just this year announcing new footwear offerings, including its first ever men's collection.
The average wealthy American, which according to Charles Schwab is a person who has $1 million or more in investable assets, has about $4 million of value to transfer. But the way they plan to pass that money along often varies by generation. Here with more is Susan Hirschman. She's the Director of Wealth Management at Charles Schwab. And Susan, we often talk about the great wealth transfer on this show, but there are a lot of nuances around it. So I wanted to ask first, what made you want to pursue this as a study? Is this something your clients often ask you about when it comes to planning for this?
Well, in terms of wealth transfer, the great wealth transfer, right, is expected to happen over the next 10 years and so. And so it's a big focus of clients' concerns, as well as the people that are going to be receiving the money's concerns. And educating people on the what, the why, the when, the how is incredibly important to us.
One interesting part of this report, I thought, is the debate about whether or not to pass on wealth when you're still living. So what are those preferences? What are the factors that go into that? And how do we see this split among the different generations?
Yeah, I think that's a fascinating outcome of the studies, that we saw a difference in generations. So the baby boomers are looking to pass on wealth after they pass, where the millennials and Gen X are looking to pass on wealth during life. And I think a few different factors happen because of a few different factors cause that. And one with the millennials and Gen X is I think they want to experience life, right, with it and the joy with their kids, as well as when we look at housing costs, right? And you look at how are the millennials doing in terms of outpacing their parents. They're the first generation to be below 50% in terms of outpacing their parents. And so there's help needed to purchase homes and the like.
So that brings me to my next question. What type of wealth is most being transferred? Is it real estate? Is it cash and investable income? Or is it?
Yeah, it's a combination thereof, but real estate is a big portion of people's wealth. So real estate is one aspect, as well as investable assets and the like, yes.
What about something like Bitcoin? It's an asset that we're talking about a lot recently. Is that something that you've seen become more of a wealth transfer question from your clients, or is it still a little too new?
It's a little too new still, and I think it's more, I mean, obviously there were early adopters, but for more of our clients, they tend to be very much goal-based asset allocators looking to achieve their wealth over time. And so the Bitcoin is more of a speculative investment for them, so it doesn't really come into the wealth transfer conversation.
Okay, and for those that are starting this process, is there an ideal time to start it, whether it be age or if you hit a certain amount of wealth, should you start to think about this?
You know, what we saw in the survey was that people begin to talk about this in and around age 45, and when they have $1 million of those investable assets, not considering their IRAs and or their real estate, right? And so that's when they start considering it. However, if you do have kids, right, estate planning should be done before you reach those milestones. But estate planning is about two things. One is about incapacity, and the other is transfer of wealth and to who are you giving those assets to. And so you have to think of both, so it's not just about dying. It is a little bit about disability as well.
Is estate planning an area that sometimes falls through the cracks when it comes to that planning process?
Exactly, and I think a lot of people just put it off because it is an emotional issue, and also making decisions sometimes are hard. And you have to think of family and the dynamics of the family and complications of the family, and sometimes it's best in certain people's minds just to avoid everything. But when you avoid, I always say you leave a legacy of chaos versus a legacy of calm and control.
So if you're in that position where you are ready to do this, you are starting this journey, this process, what are the first steps that you should take?
The first steps is taking an inventory, right? What do I have? What's my balance sheet? What's my income statement look like? And then what do I want? Who do I want to give my assets to? So we always say there's 4 places your money can go. It can go to you, it can go to your family, it can go to charity, or it can go to taxes. And figuring out, usually the taxes is the least, and figuring out which of those 3 quadrants, how you want your money allocated to those, is what you do next.
Well, some great nuggets in this study. Susan Hirschman, thank you so much. Appreciate your time.
Thank you.
Well, we're in the home stretch of 2024, which means now is the time to make sure your finances are set up for the new year. Yahoo Finance's Molly Moorhead has the top 3 most important financial moves you need to make before the year is over. So Molly, what should folks be keeping in mind?
Yeah, there's a lot to do before the end of the year, but I think the 3 most important ones are, first, do a checkup of your budget. Even if you're not somebody who writes down every single purchase you make, it's still a good idea to go in and pull a couple of months worth of bank statements, credit card statements, and make sure those line up with what you're spending and with what you think you're spending. Maybe you took out a couple of new subscriptions, streaming services, gym memberships this year, and you're not aware of a monthly recurring expense. And this is just a way to get that visibility and get on top of what you're actually spending against what you're taking in. The second thing is to shore up your emergency fund. Ideally, you want to have 3 to 6 months worth of expenses set aside in a savings account, money you can easily access. And so let's say that's $5,000 for your household and you only have $2,000 in there. Well, maybe you can't immediately put $3,000 in there. That's when you can go back to your budget and make a plan for the first few months of the year to put a few $100s in that emergency fund to get it up to that healthy level. And then the third thing, this is really calendar dependent, is if you have flexible spending accounts through your employer, these are those pre-tax accounts where you contribute money and you can use it on specific expenses like healthcare or childcare. These accounts are great, but the catch is you have to use the money by the end of the year. If you don't, you forfeit it. So if you've got money left over in an FSA, find some medical receipts, find some daycare receipts, and spend that money and get reimbursed for yourself.
All on my end of year to-do list. Molly Moorhead, thank you so much.
Thanks, Allie.
Much more on wealth after the break. You're watching Yahoo Finance. A programming note on this week's episode of Warrior Money, hosted by former Congressman Patrick Murphy and veteran investor Dan Coons, Edge Runner AI CEO Tyler Saltzman points out the need for VC firms to recruit people with more diverse backgrounds as they seek to enter the defense tech space.
The biggest problem I see with VCs, and I've talked to many of them, is you have these kids with 5 or 6 of real world experience. They get an MBA from Wharton or GSB, and they're now the gatekeeper of a bona fide VC firm. And if they never built anything and they never really had life experiences, how is this person the gatekeeper into a potential a seed round or a Series A? And I think that's very concerning. And I would challenge VCs to look for folks with different types of backgrounds rather than just MBAs. Let's get some military people. Let's get some folks that have actually built things.
You can catch episodes of Warrior Money Fridays at 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. A Gallup survey this year found 51% of U.S. employees are watching or actively seeking a new job. And 34% of people surveyed said moving away from a bad manager or leader is very important when considering whether to take a new job. Here to discuss the employee-manager dynamic is Jamie Wolf, founder and CEO of Creativity Partners, a firm that helps organizations build healthy workplace cultures. Jamie was also the first director of culture at Pixar Animation Studios. Jamie, thank you so much for joining us in studio. I love this topic because it's one I think most people can relate to. So can you break down the financial impact of having a bad boss, whether it be for the employee, but also for the corporations?
Yeah. Well, first of all, the problem is massive. If you talk to employees, your average employee, about 75% will say that their boss is the most stressful part of their job. Not deadlines, not the work, the boss. So with bad bosses, there's really high turnover. And turnover, we know, is costly. The recruitment costs, the cost of onboarding, the cost of the downtime when we're replacing the employee. And then there's the healthcare costs. There's a study that shows that if you have a bad boss that causes you stress, you're 60% more likely to have a heart attack or another serious health issue. And not to mention the quiet quitting, so for the time that you're not enjoying this stressful boss, you're at the water cooler spending all your time talking about how much this boss is causing us all stress.
So let's say you do have a bad boss. What can you do to protect yourself, protect your mental health, but also make sure that you are performing and not falling into that quiet quitting trend?
Yeah. Well, it's difficult, and I would say it is a massive mental health crisis. It really is. It's one that we don't talk about, but because it's a mental health problem, find support systems at work. Find people who you can share the perspective with, not in a complaining kind of toxic way, but just people who can support your sense of self-worth. But one of the things that I think people neglect is to just try to give the boss feedback. That's always a good first step, is to say, look, when you shut my idea down, it makes me less likely to bring ideas up to you. And I know you want us to surface problems to you, but when you said to me, well, stop complaining, it makes me feel reluctant to continue to have an open door to you. The other thing is to document the conversation verbatim, not just to create a paper trail, but also just to remind yourself of your self-worth. You're not making this up. There's a pattern that you're now documenting. And the other thing is just to remember you shouldn't have to survive a bad boss.
Right. So with that, is there no other option really than to leave a company? Because I sometimes feel like if people bring it up, there's no immediate changes right away, right? And that could be frustrating, and that can trickle through in your performance at the office. So is that ultimately what you normally see happen?
It just depends, because there's so many kinds of bad bosses. There are bad bosses that you can reform with feedback, for example. So sometimes people complain to their friends, but they haven't even complained to the boss. So that's why I say, see if this boss is reformable. If it's a pattern and it is causing you sleep disruption, stress, there are so many people that I coach who have had really serious health problems. It is time to start writing your resume and get out. But I think there's also options within companies to look for jobs within companies. I don't recommend to people to stay with a boss where you've tried, it hasn't worked, and it just feels like your mental health is deteriorating.
And as a workplace, how do you foster an environment where you don't have negative leadership, that you're supporting your employees?
Yeah. Well, one thing, we work with companies, and so we talk to the executives. Stop promoting people who have a reputation of being a jerk. It's just not worth it. You can have bad bosses, you can have good bosses who get quality work, who are exacting, who have high standards, and who elevate and empower people. So you can have both. So start promoting those people and start hiring those people. And the other thing is, we've seen huge transformation with 360-degree feedback. So, you know, bosses have blind spots. The higher up they go, the more distorted the truth, because people stop telling you the truth and they start nodding their head, laughing at your jokes. And so it's really important to give the feedback and have that be anonymous, and make sure that the company is ensuring there's accountability, that there's action after the 360.
So is that key to keep it anonymous? Because you probably have employees that are scared to speak the truth.
And they are. And so, you know, 360 is suspect because even if it's anonymous, people are afraid. But that's what I've seen turn things around more than anything, is a good 360 process.
All right, some great advice, Jamie Wolf. Thank you so much. Appreciate your time.
Thank you.
And that's it for Wealth. I'm Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern.